I'll make a very brief announcement in the beginning.
Great. So thank you so much. This is joint work with Pierre Olivier, who most of you know. And this paper's called, yeah.
Saki,
Oh, sorry.
Yeah, but I'm just gonna explain the format before Saki starts.
Okay.
Saki already presented the title of the paper. Let me just explain the format. So welcome everyone to the SaMMF workshop on financial intermediation and security design. There'll be 4 talks in this workshop. Each talk will have 1 hour. The presenter will present for 35 minutes. Then it will be followed by a 15-minute discussion by our discussant. And then after that, there will be a 10-minute open Q&A. For panelists, if you have questions during the talk, feel free to ask the questions live, or you can post your questions in the chat window. And for attendees, if you have a question, you can ask your questions in the Q&A window. We'll pick them up in the 10-minute open discussion at the end, or the co-authors will answer them live. Okay, Saki, I'll give the window to you.
Thank you very much, Nathan. So, well, let me jump ahead to the presentation. So, liquidity transformation. So, let me begin with something which is very big picture. So, when we think of banking and the banking literature in particular, we often hear that bank is about maturity transformation. But there's another fundamental thing that banks are doing, which is liquidity transformation, which we think is at the core of the banking system, and is important to understand what type of assets they bring to their balance sheets. It's much more than just saying, we're going to issue short-term security for long-term project. They bring into their balance sheets all types of security. They could be short-term in maturity, but that they have different properties in terms of the liquidity, and that's something that I'm gonna detail in a second. So if you think of what banks are actually doing, they're acquiring many assets, loan to business owners, bonds, securities, etc., and they're issuing liabilities, deposits. But the important feature of deposits, and that's what I refer to liquidity transformation, is that deposits circulate. A business owner that acquires a loan from a bank obtains a liability from the bank, and he starts paying workers, and workers can pay other people for goods and so on. So these liabilities that bank creates are assets that circulate in the economy that are used as means of payment. And furthermore, something that I'm not going to talk about this presentation, but I think it's underappreciated, is the fact that banks not only create liabilities that are liabilities of their own, they create joint liabilities that circulate and end up being liabilities of other banks, creating a system of cross settlements. So that's something where in this project we're moving toward thinking about, but I'm not going to talk about it. I just wanted to point that I think it's an important aspect, and we're working toward that. So what we're going to do is specifically in this paper is ask, within an economy, which assets should banks acquire, what liabilities should bank creates, at what terms of trade, and when are those when is that process of liquidity creation efficient? So there's a long literature. We connect with many papers, but we have these specific connections. So Gorton and Penaki had this idea that banks create liabilities that circulate because of asymmetric information. That's going to be core to our paper. There's been recent developments, and this is a topic of this conference, the idea of security design, the idea that there are assets out there that we can create liabilities or other assets backed by certain assets, changing the informational properties of these assets so that some transactions can take place. The idea that we can bundle different assets and create security in the spirit of security design, and the idea that different private liabilities can be used as money. So we connect with all these themes. So let me jump to the environment. So we're going to model banks. On their asset side, they're going to participate in a security market, and they're going to trade with heterogeneous assets. And then in the economy, some assets are going to be liquid and others are going to be illiquid. They cannot be used as means of payment because they're exposed to asymmetric information. So what banks are going to engage in transactions in this market, they're going to participate in this market. And they're going to issue liabilities that can be used as means of payment, try to extract some rents if possible, or engage in creation of liabilities or liquid liabilities when possible. So what I'm going to do today is discuss two environments, one where a monopolist bank finds a number of entrepreneurs that have assets that wouldn't be able to circulate on their own, and then engages in offering them different liabilities in exchange for those assets, and then those liabilities can be used as a means of payment. So that's going to be the monopolist case. And then we're going to also study, I'm going to start by talking about a competitive equilibrium where this occurs in a decentralized market. There's no monopolist offering a specific contract to its clients. So we're going to study to compare two market settings. So Ariel is going to discuss only the monopoly case because that's the only case that is written in the paper in the current draft right now. But I wanted to show some new results. Okay, so before we talk about the security design or the creation of liabilities by banks, I want to talk about bilateral exchange. What could an entrepreneur do if it has different types of securities that vary in their information content? So we're going to think of 3 dates, 0, 1, and 2. And right now, as I talk about the bilateral exchange, I'm going to focus on periods 1 and 2. And before that is when those liabilities are created. So there's 3 dates. There's 2 aggregate states in the economy. Very simple, a low and a high state. And they have a probability pi for the realization of each state. So there's a continuum of agents, producers, and workers, and they're going to meet bilaterally. So the producer is going to be endowed with different securities. We're going to denote securities by D generically. So D, each security is a vector with 2 dimensions. The first dimension is the payoff in the low state, and the second dimension is the payoff in the high state. So that's how we're going to represent securities, just as vectors in R2. So a security pays D in each of these corresponding states omega. So one example is a safe asset, an asset that pays 1 and 1 in each state. Another example is a risky asset, one that only pays, say, in the high state, that would correspond to a narrow degree security. At time 1, you can think of this as, in the spirit of search and matching, these agents are going to meet, and they're going to bargain. The producer and the worker are going to bargain. So this follows much the spirit of Lagos on the right. So the worker can supply labor at a marginal cost of Q, or sorry, marginal cost C of Q, which is linear in Q. So Q is the number of hours. So it's linear cost. And the producer has access to a technology, but the technology depends on the aggregate state. So there are periods in time where the payoff of hiring a worker is positive. There are other periods where it's, there's no benefit just because the output is not 1. So in particular, in the high state, there's a benefit of hiring a worker, and in the low state, there's no point in hiring a worker. It's a useless transaction because the rate of return in the low state is equal to 1. I'll detail that in a second. So there's no commitment. So because there's no commitment, the only thing that these entrepreneurs can do is pay the worker with a security. And then an important feature in the environment is that the security is private information. So the payoff of the security is private information. So at the time they meet, at time 1, already the entrepreneur knows omega. So there's an asymmetric information problem in this bargaining for hours. So we're going to make some assumptions. The first assumption is what I was just saying a second ago, which is that in the low state, the rate on return on per hour worked is equal to 1. So there's no point in hiring a worker. It's a useless transaction. But in the high state, there is a benefit of hiring a worker. There's a payoff. And so we're also going to make an assumption, a parametric assumption, that will imply that there's a lemons problem in the high state. So you see, if we're in the low state, the only reason why an entrepreneur would want to transact with a worker is to rip him off. There's no economic benefit of hiring a worker. But because the payoff of the security can be below 1, it would want to rip off the worker and get an hour of work, extract that hour, and pay him a security that is worth less than 1. So if you make this assumption, this parametric assumption, you have a lemons problem. So what that means is that if you sell the high security at the expected value, you're going to get less than 1 for 1 in some instances. Okay, for at least for some securities. Okay, so let's focus on what trades can be achieved with a particular security, with an arbitrary security D, subject to the information constraints. So we're going to find the following. So if the payoff in the low state is below the payoff of the security in the high state, and you satisfy the condition that the expected value of the security is multiplied by the high state, by the return in the high state, is lower than the value of the security in the low state, you're going to find that the lemons problem arises in this particular security. So what that means is that there's no trade in that security if this condition is satisfied, and therefore there are no hours. So this becomes an illiquid security. So if these conditions are not satisfied, then potentially the security can be liquid. So in particular, if it satisfies the condition that the expected return is multiplied by the value in the high state, then the entrepreneur is willing to sell the security for the hours because that's worth more than keeping the asset. So that's what this inequality is capturing. So in that case, there is trade, and the security is valued at its expected value. So in the high state, the security is suffering a discount. So that's a feature of the lemons problem. And you can have another situation where if the security is inversely related with the aggregate state, then there's complete separation, and then you can trade in both states at the corresponding prices. Okay, so that covers a full set of possible payoffs. So you have a lemons problem, a possible separation, and a possible pooling outcome in the securities. So we're going to focus on, in particular, in these two cases, and not pay much attention to the third case, but we've done most of the work in full degree of generality. Okay, so this is the possible asset space. So suppose we take payoffs R and R. So this should be D and D, actually DL and D high. So if the securities the payoffs fall below the 45-degree line, so this dashed line is the 45-degree line, then you can have a separation and you can trade with the security at their price in both states. If the security falls in this region, so it falls below this lemons condition, the security still circulates. You can still make payments with the security. In the high state, it's valued at the average price, but there's still trade. And if it satisfies the condition that the payoff in the high state is sufficiently high, that means that the security is sufficiently, there's too much information sensitivity in that security. So what that means is that it doesn't circulate. So depending on what where the securities fall, there's going to be a utility for holding the security. If the security falls in the red region, meaning that the payoff in the high state is so high that there's a lemons problem, that it doesn't circulate, the value of holding of the security is just the expected value. The entrepreneur will just hold it. If the security falls in the green region, it means that there's full separation. So it means that it will trade at the exact value in both states. And the value of keeping the security is just the expected value times the expected use of the security. And in the blue region, you have this property that the security is always sold at the expected value. So it's in a pooling equilibrium, and you get the expected return per unit of hour work. So the entrepreneur will sell it at the expected value, and then on each state, on average, it will get this rate of return. So these are the different valuations that can have depending on which region we're in for the security. So this is going to be an input for the next step, which is the creation of liquidity, being it in the market or in the monopoly area. So I just want to point to some properties. You can express this condition, this line, parametrically. So you're going to have the maximally liquid security or liability are going to be those that fall exactly on these lines. Those for which the rate of return is in the high state is highest possible given a rate of return in the low state, and the security still circulates. And you have a single parameter that captures that that liquidity condition. So it better be the case that if the security pays R bar in the low state, then in the high state, it should pay at most psi of R bar, where psi is given by this expression. So you can re-express things as saying, if the security satisfies the condition that the payoff in the high state is below this liquidity coefficient, then the average utility obtained from holding the security is just the expected value of the security as an equaling outcome times the expected productivity of the work. Okay, so these two parameters are going to be important, psi and rho. Okay, so now let me turn to a competitive equilibrium. So the idea that we're going to start with different assets, banks are going to have other assets, they're going to create different types of assets, and there's going to be an exchange for different types of assets, and we're going to try to see what market outcomes occur in that scenario. So what's happening here is that at time zero, we start with not securities, not pieces of paper, but actual physical assets. So trees, you can think of them as trees. So you can have a tree that is a security in itself. So R is like the payoff of a tree, and you can think of it as a security in itself. It's like a tree that pays in a high state or in a low state. And there's an initial measure for a set of entrepreneurs that have holdings of these trees. So mu is like a measure of ownership of different trees, and bankers have that another measure of ownership of the set of possible trees. Okay, so these are the initial endowments. At time zero, there's an exchange of trees for bank liabilities. So entrepreneurs will go and in a valuation market exchange trees that possibly could circulate or possibly would not circulate because they're securities on their own. They will exchange them for a measure over a set of illiquid liabilities or liquid liabilities and illiquid liabilities. So there will be like creation of assets, some of which will be liquid, some of which will be illiquid. Each asset again is going to be indexed by D, and there's a measure over D of liquid assets and of illiquid assets. The banker in turn will also participate in this valuation market, but different from the entrepreneur that can only buy assets and not create assets. The banker can, buy certain securities, but it can also issue securities. It's going to have to satisfy a resource constraint, but it can also create securities. So it can have negative positions on assets. The entrepreneur cannot. So that's going to be the key distinction. However, the entrepreneur can trade with a worker. So that's where the gains from trade are. So the entrepreneur trades with the worker using the bank liabilities, and the condition to, think of a liability as liquid is that it satisfies this exact condition. And in this competitive version, there's a price for liabilities and a price for trees. There's a function depending on where these two vectors lie. Okay, so this is the problem of an entrepreneur. So it starts with an initial measure over trees, and this corresponds to his total wealth. So each tree R, so we're noting a tree with R, is going to have a price. R is in 2 dimensions, but it's indexing what asset it is. And so it's going to have a price. That's the income or the wealth. And then it's going to spend that wealth into two different measures. It can spend buying some liquid securities, D, he has to pay the price. And then he's going to spend some on illiquid securities, also paying a price. Okay. The difference between liquid and illiquid liabilities is that you can think directly as what's going to happen with trade. This is just using what the pattern of trade is. For illiquid liabilities, they're going to hold to them, and they're going to just get the expected value of this aggregate tree. So you can think of once we integrate it, it sums up into a vector that says there's going to be a high payoff state and a low payoff state, and this gives us an expectation. If we take the liquid trees, the banker is creating these liquid liabilities. The entrepreneur will take them to trade if they are liquid, if they satisfy that liquidity condition, and then that's going to give us a payoff of U. For the banker just cares about, that he's not going to trade, so he just cares about his own consumption per state. So what happens is that he starts with an initial budget. Okay, so he starts with some initial wealth. He can add to his source of income by issuing liabilities. So he has a source of funds issuing liabilities. So these are short positions on these liabilities that possibly circulate, and then he can possibly hold on to a positive position on other liabilities. Okay, so what happens is that because the banker is creating these liabilities, it better be the case that when he pays off for the liabilities that he issues and considers his own consumption per state, in each state, he better have the resources in each state to satisfy the condition. So he has a limited liability. He'll never go negative on his position, and his consumption has to be positive. So there's a limited liability. Okay, so that puts a constraint on how much he can issue. Okay, so then a competitive equilibrium is a price function over this whole space of securities and portfolios of illiquid and liquid securities for the entrepreneur, and short and long positions for the banker, such that the measures are chosen optimally and markets clear. So what does market clearing mean? Well, if you take any security D, if you take the initial measure where D is equal to R of that security, so this is the initial endowment, whatever's shorted plus the initial endowment adds to a security, is the security supply. So it's the supply of D. And on the left-hand side, you have the demand. So it better be the case that it's either held as a liquid security, or held by the banker ultimately. Okay, so that's a condition that has to be satisfied point-wise. Okay, so let me introduce some notation toward the characterization. And just give me a second. I'll open my phone to check the time. Okay, so just for notation, let's set up some basic notation for Arrow-Debreu securities, because we're going to solve the problem in the space of Arrow-Debreu securities. So you can think of the security that pays in the low state and the security that pays in the high state as being just 1, 0, and 0, 1. And notice that the liquid security, the one that pays only in the low state, is liquid. So this is, you can think of these as the liquid Arrow-Debreu, and EL as the, or E high, sorry, as the E high as the liquid, and EL as the liquid, and E high as the illiquid. So sorry, there's a typo. And we can think of a maximally liquid security in the Arrow-Debreu space. So that's one that pays 1 in the low state and psi in the high state, which you can construct this way. Okay, so in any equilibrium, in any competitive equilibrium, you're going to need a numeraire. So we're going to think of the price in the high state as the numeraire. Okay, so we're going to set pi as the numeraire for the the price of the high state Arrow-Debreu security or illiquid security as the numeraire. So I'm setting the fair valuation of the high state as the numeraire. And to simplify notation, we're going to call P of the liquid security is just a single number. So we're going to call that Q. So remember, P is a function over the whole security space. Q is the price in an equilibrium over the liquid security. Okay, so some notation for prices. So I'm going to now find two possible notation or terminology. So the first thing is, given that the probability of the illiquid security is pi, and the corresponding price once normalized is pi, if things are valued fairly, what that means is that the low state security is valued at its expected value. Remember, everyone is risk neutral. So this is the fair price of the liquid security, 1 minus pi. But in turn, what's going to show up currently in the solution is the maximal value of a liquid security. So the maximal value that we can attain from a liquid security is the following. So we can do the following. When we can price the security at its maximal value as saying the following. Well, if you take the expected value of the security at the valuation of the worker, so that's the security that is liquid, that pays only in the low state, that's the expected value. It's 1 minus pi. If that security is used for trade, then it's going to have a valuation of rho times that value. But in turn, with liquid hour de Bruce security, what the agent can do is also borrow on top of that. It can borrow up to the liquidity condition at the price pi, and taking that value, it can exploit the gains from trade, using it to trade with a worker, and then it pays back the value. So this is the maximal value that we can get. We can think of getting from a liquid security. You can trade with it directly and exploit the gains from trade. But if you can take that security and on top of that, take an illiquid security as if you were borrowing it, take the maximal amount that you should borrow so that the transaction is efficient, then you also get some extra value from holding that security. So this is like the fair pricing, and this is like the maximal value that we can extract from a liquid security. These two objects are going to be important for the characterization of a competitive equilibrium. So in a competitive equilibrium, we're going to find that any security is priced at its replication cost using hour de Bruce securities. So we can just think of a price of a, sorry. Yeah. I'm in a meeting. I'm going to be done in 15 minutes. Are you going to stay here? Are you going to stay here?
Even if we're here, I don't know. We'll go in.
Sorry about that. I'm in a public space. All right. Sorry. So any security is priced at its replication cost. So you can think of any security as being the sum of two hour de Bruce securities. If you take the payoff in the high state and the payoff in the low state, and this is the quantity of high state hour de Bruce securities and low state hour de Bruce securities. If you multiply them by the prices, it gives you the average price. So that's a property. So there's no arbitrage. Then when we go to the banker's problem, because there's no arbitrage and the banker has nothing to gain from intermediation, we find that the banker's problem is just equivalent to taking his entire wealth and choosing between two hour de Bruce securities that tell him what are his consumption in the high state and what are his consumption in the low state. Pi is the numeraire and Q is something we have to solve for. So depending on what the price of the liquid hour de Bruce security is, we're going to obtain different conditions for what the banker will do. So if the security has a negative liquidity premium, so it's below fair value, the banker says, well, you know, there's no point in me holding any liquid security. It's simply too expensive. So you're gonna, there is no point in holding the illiquid security. I might as well buy the liquid security. It's really cheap. It's not expensive. If it's fairly priced, then he's completely indifferent. And if it's if there's a positive liquidity premium, then the liquid securities is expensive for the banker. So he only buys the illiquid security. So so when we think of the entrepreneur solution, it's going to have very similar features. So if the securities has a negative liquidity premium, so it's below fair value, he'll only buy the liquid security. Why? He can trade with it, and it's actually cheap. If it's fairly valued, he's indifferent between any portfolio that is liquid. So if securities are fairly valued, he can construct liquid portfolios with hour de Bruce securities fairly. There's no cost in building a liquid portfolio, and he'll strictly want a portfolio of securities that is liquid, that is used for transactions. There's no point in wasting, you know, in purchasing securities at a fair value that wouldn't trade. So in this stage, he prefers any liquid security. You can get the exact gains from trade from any liquid security at the same cost. If there's a positive liquidity premium, then something happens. He only wants the maximally liquid portfolio, and possibly he'll hold some illiquid securities. So what's going on? So he says, well, I want to maximize gains from trade, but to maximize gains from trade, I need liquid securities in my portfolio, but they're relatively expensive. So if I'm going to buy any liquid security, it's going to be the maximally liquid. So the one that for each unit of liquid security, I maximize the cheaper part, the illiquid security. So if the security is below, if the price of the security is below Q star, then he will only hold the maximally liquid security. So he'll fall in this liquidity line. But there are situations where the maximally liquid security is actually so expensive, it's so high, it's actually the value is Q star, so it's extracting all the value, that he's actually indifferent between holding a maximally liquid and an illiquid security. And then if it's overpriced, he just says, well, getting gains from trade is really expensive. There's no point in building a liquid portfolio to trade with a worker if it's going to be so expensive. So there's a condition that tells us what the price is going to be in equilibrium. I just told you what the solutions are for the optimal portfolios given Q, but I haven't told you what Q is. So here comes the interesting part. So if you let the relative wealth of entrepreneurs, you sum up all their initial endowment and the one for bankers, and you sum up all their initial endowments, and you denote by N the wealth, you can express the relative wealth as eta. So eta is the relative wealth of entrepreneurs. And if you can take the sum of low state endowment and high state endowment, so you can think of the aggregate Arrow Bruce securities that you obtain from the initial endowments of trees, then you can denote the share of liquid trees to illiquid trees as gamma. So these are two critical objects in the characterization of the price. So notice that if gamma is below psi, then the aggregate endowment is low. So we're going to use these two terms to characterize the price. So here's the main theorem. So the main theorem says in any equilibrium, the price is going to be bounded between the fair value of the security of the liquid security, or the liquid Arrow Bruce is going to be bounded between the fair value and its maximal potential value once it extracts all the liquidity potential from the illiquid security. And in equilibrium in particular, if you tell me what eta is and gamma is, we can tell you exactly what Q has to be. So if you have values for eta and gamma, so eta is relative wealth and relative stock of liquid assets or liquid Arrow Bruce securities, if this value is above the fair value, then we stay with this price. If it's below Q star, then we stay in this price. So it's just like a step function. And it depends on the relative quantity of liquid assets vis-a-vis wealth of the entrepreneur. So notice that the critical thing is this intermediate value. So it needs some interpretation. So what happens is that when you have excess liquidity, so when the price of the liquid asset is valued below fair value, that means that there's no liquidity premium. Entrepreneurs only hold liquid securities, and bankers are indifferent between holding the each of the Arrow Bruce securities. So it's a situation as if you had excess liquidity, so it's priced cheaply. The other situation occurs when liquidity is scarce, so it's when it's within this intermediate value, or when it's really, really expensive, when it's at the maximal value. So what is this term? What does this formula represent? What is the meaning? Well, when this condition is satisfied, what that means is that if you rearrange it, it means that the maximal value of the entire liquid portfolio is not is too expensive, such that the banker's wealth is not enough to purchase it. So the banker is the only one that can use liquidity to trade with the entrepreneur. So this expression is telling us that if you rearrange things, this is like the relative wealth of the entrepreneur. So if his relative wealth is not enough to buy the maximally liquid portfolio, that means that there's an excess supply of liquidity. In the other scenario, when the excess, when this condition is above the maximal potential price, rearranging things, what this condition is telling us is that, in an equilibrium, what needs to happen is that the banker buys all the excess illiquidity. So what that means is that if you take all the maximal liquidity that can be created using illiquid trees, there's a stock of illiquid trees, and if you subtract, the amount of illiquid trees that can be combined with liquid trees, that gives us the excess supply of illiquid trees. So if the banker cannot purchase the excess supply of illiquid trees, what that means is that the entrepreneur will end up with illiquid trees, stuff that it doesn't need, or he values at the fair price, and he has no use for it. So that's a situation where the price, is exactly at the maximal value of liquidity. So the entrepreneur is, paying as much as possible, getting rid of all the illiquidity that he can to get liquid securities. But at some point, the price is so high that he's just indifferent.
Saki, so maybe this is a good place to wrap up.
Okay. Yeah. So what's going on is, if you think of if we map the Edgeworth box, there are situations where, the budget constraint will fall here, and this is the ISO value of holding securities. So this is where they are when they are liquid. It can be the case that the net worth of the entrepreneur is so high that it ends up being at this corner where there's simply not enough liquidity to satisfy his budget constraints, so he ends up holding some illiquid assets. So if you have no net worth for the banker, the conditions boil down essentially to whether the aggregate holding of liquid to illiquid trees or the aggregate portfolio is liquid or not. So if we take some stock, banking activity is critical for liquidity creation, but there's no, in this version, there's no reward for creating liquidity. Bankers, in fact, could sell all their wealth, their initial endowment, and there's no point exactly in creating intermediation. In fact, it's inefficient to have wealth on the hands of the entrepreneur because some liquidity that could be created is not and exploited is not used. And in practice, they do joint liabilities. So all in all, because there's no point in having, there's no rent extraction from the banking system, there's a tendency to concentrate. So it's not natural to think on monopoly. So what about monopoly? So the second part of the paper discusses the monopoly case. And there, the main message is that the monopolist banker always creates the maximal amount of liquidity, just as the market equilibrium. And he may give less than the necessary or than the maximal liquidity that could be created to the entrepreneur because he's extracting some surplus, and in some instances he creates illiquidity or illiquid securities to compensate the entrepreneur for the outside option. So I ran out of time. So anyway, so this is a simple model to think of. Bank balance sheets driven by incentives to issue liquid liabilities, it's what you saw. So thank you.
All right, thank you. Our discussant is Ariel Zazin-Jones.
Hey everyone, it's great to see all of you. Sure. There, now I can see you all. So, this is a really interesting paper. I'm going to apologize to Pierre-Olivier and Saki. I wish I had more time. So I might send you another discussion in 2 weeks. I find the paper quite interesting and thought-provoking, and I want to work a little harder through it. But I'll start here. An embarrassingly long time ago, I presented a paper that had something called a bank at one of the summer search and matching money conferences. And I remember Randy said, "What's a bank?" And I gave a very narrow answer in the context of the model. It's actually, I think, a question we all struggle with, right? What's a bank? I'm seeing this now show up in my niche area, thinking about cryptocurrencies of, which of those are banks and how do we debate this and who should be regulated. But, I think we approach thinking about this question in a few different ways. And this paper, I think, is trying to give us a new perspective on this. So some people define a bank as a set of firms who generate some kind of social or private value from some specific activities. When I say deposit taking, I really mean they create insurance against idiosyncratic liquidity shocks. When we think about lending, we think about screening, right? They screen borrowers on behalf of lenders. What this paper, I think, is trying to go after more is this role of banks play of creating payment assets, liquid assets that circulated the economy. Now, some people like Gary Gorton would say, no, that's not how we define a bank. A bank is just an entity that issues demand deposit-like claims. Now, I think in this crowd, we all understand that kind of confounds the underlying economic activity they do with how they happen to do that economic activity. And it's a bit of a struggle to understand that. Perhaps a more narrow way to define this is just whoever's regulated in some way as a bank. I'm not sure what the right is. The usual approach we see is you mumble something like, I don't really know how to define it, but I know it when I see it. And so I appreciate this paper trying to take a deep dive to understand what is a bank, why do they look the way they look, okay? And I think their definition is of a bank here is a firm that transforms illiquid assets into liquid assets. There's some assets in the economy that for whatever reason cannot circulate, and the bank can take them onto their balance sheet and replace them with ones that can. And when you start with that theory, they then, I think, want to ask some questions. Like in the data, the agents that seem to do this seem to sell a mix of liquid and illiquid liabilities. Banks take a bunch of illiquid assets onto their balance sheet and they replace them with a mix of liquid and illiquid liabilities. You might also ask, why do banks buy a mix of safe and risky assets? Why might they buy liquid and illiquid assets also? So they want to kind of jointly understand both sides of the bank balance sheet. So what do I want to do today? I want to first try to clarify the role of the bank in the model. I'll give it away. The bank here is, quote unquote, fixing the Akerlof problem. That's my interpretation of it. So I want to illustrate exactly how they're doing that with a really kind of trivial example. Okay, there's not going to have the richness of the paper in any way. And I don't think my example can generate this mix of liquid and illiquid liabilities, but I think it highlights what's going on. And more than that, though, if you're proposing a new theory of banks, I want to ask some questions about what about the other side of these trades? So who's buying these liabilities and who's selling which assets to the bank? I want to see if the model helps me understand better some features of the data. And I want to point to some, my approach to this is going to be extremely crude, and it might at the end sound like a bunch of random disconnected facts. So I'm going to apologize in advance, but it's a direction I'd like to see the paper go of, besides just staring at the bank balance sheet that the theory helps me get closer to understanding, does it match up with who's trading with banks in some sensible way? That's what I'd like to try to understand better. So here's my simple theory. It's based on a crude Akerlof-ish model. We're talking Akerlof, so instead of banks, I'm going to call things about cars instead of assets. So I'm going to have a measure of car dealers who each own a car. And I'm going to make this simple here. They all own the exact same model of car. Okay, so there's just one type of car out there. And with some probability, there's going to be some critical but unobservable to customers or consumers design flaw in the car. Okay, it's a lemon. And with some probability mu, the cars are fine. What are my car dealers' preferences? They like good cars over bad cars. VH is bigger than VL. What about buyers? Buyers also like good cars over bad cars, but importantly, there's gains to trade when the cars are good. Okay, so buyers value a good car at rate AVH, where A is bigger than 1. Does everyone see that? Good cars are worth more in the hands of buyers or consumers than they are in the hands of dealers. In the low state, there are no gains to trade. What's the timing here? My buyers are going to offer a price to buy a car. Dealers learn the aggregate state and then decide whether they want to sell the car. Okay. Now, what's the interesting case? The interesting case is when, if a dealer gets a good car, they wouldn't be willing to trade at the pooled average price. So what are buyers willing to pay? That's on the right-hand side. It's this term here. With probability mu, they're getting a good car. They value it AVH. With probability 1 minus mu, it's a bad car. This is the most they're willing to pay for an average car if everyone's trading. And a dealer with a good car in that state will not trade. So the pooling equilibrium does not exist here. The only equilibrium is no trade. Okay. This is also a reason why it's important there are no gains to trade in the bad state, right? I mean, people are in the bad state, they're willing to sell at price VL, but they're equally willing to hold. So what do dealers get in this simple model? in equilibrium, dealers would just get their average valuation of the car. Okay. So what does the quote unquote bank do in this model? You know, this line, maybe I should have rewatched The Sopranos. I didn't, you know, that's a nice car you got there. It'd be a shame if something happened to it, right? When the mob is threatening you. Here in the model, it's different. It's a nice car you got there. It would be great if something happened to it. And what do I mean by that? What the bank is going to do is say, look, I'm going to offer to dent your car when it turns out to be nice. I'm going to reduce its value from VH to ZH. Okay. Now, why was pooling not in equilibrium? Pooling was not in equilibrium because the valuation in the high state was too high. And if the bank can reduce the value in the high state, notice what happens. The left-hand side falls faster than the right-hand side when, as Saki put it, there's a Lemons problem, when mu A is smaller than 1. So by reducing the value of the car in the good state, you can suddenly make the car more liquid because there's less adverse selection. A good car and a bad car are more similar. And so what happens is dealers might be willing to pay to effectively commit themselves to trade the car in the good state. Now, this is costly. It's not free, right? The car they're selling is worse, so the price buyers are willing to pay is lower. So this is only beneficial when the gains to trade are large enough, effectively. This is the theory of the bank. What's happening in the model? I have an asset, a tree. I sell it to the bank. And I tell the bank in the good state, keep some of the fruit from the tree and give me back a security that pays a little less. That security is now more liquid, and so I can sell it or effectively get work out of my workers for it. That's the theory of the bank. That's the way in which it fixes the adverse selection problem. It's transforming illiquid assets into liquid assets. There are questions about how they do this. Does it depend on the size of the rent they get? Those are all interesting questions that are kind of done very, very interestingly in the paper, but that's what's going on. Now, you might ask, when does this go wrong? And what it's going to hinge on is, if you notice, right, more clearly, as VL falls, what's happening? Or actually, I should put this somewhere else. Sorry. As VL goes down, the amount the bank has to dent the car to make it liquid is getting more and more, right? ZH is getting lower and lower. And so we're more likely to violate this condition. Okay, so when does our bank fail? Our denting mafia bank fail? When the bad state's really bad, they have to reduce ZH a lot. They have to make the good car in a good state worth very little. That hurts dealers, and eventually they just prefer autarky. Effectively, creating liquidity is too costly, and so the bank only issues a quote-unquote illiquid claim. They don't dent the car. So what does the paper do in this case? What do they find? They find that in that case, what the bank can do is effectively only dent a fraction of the car. They take a portion of the producer, they take a portion of the entrepreneur's trees, and they agree to dent a portion of them and leave the rest untouched. That's the liquid and the illiquid liabilities. Now, in my model, this actually doesn't work at all. Everything's linear, so everything scales. So if you do a portion of it, you get no benefit. So in my model, I only get these polar cases, a liquid asset or an illiquid asset. In their model, they get both. I think it's because their preferences are endogenously concave. Their entrepreneurs' preferences that U as a function of adverse selection premium is concave. So I think changing the scale of assets that adverse selection applies to improves things. I'd like to understand this a bit better. This is what I meant. Maybe 2 weeks later, I'll understand it better. I'm sorry, I can't explain the source of that curvature well enough to explain this to you. But that's one point. But now let's step back. Again, I said I really like this paper because it makes me think about a bank. Having thought about banks and balance sheet transformation a lot, you know, if you ask people, by people here I mean economists, why do banks issue liquid and illiquid claims? I guarantee the number one answer you'll get is, well, households like variety. When you ask why do banks issue demand deposits, people always say, well, households want them. And that's not a very satisfying answer. And this paper instead provides a coherent theory. I do think the results sound a bit like a pecking order. On the corporate finance types have said. If Randy were here, I'd never say this. I'd be scared of getting yelled at. Who cares what corporate finance types say? But there's a bit about like you issue the least information sensitive securities first, and then when you break that, you start moving to more sensitive securities. I think there's an analogy here. I think it'd be nice to contrast a bit more how that's different. I also think about firms choosing to borrow from banks or not, who's selling their assets to banks. Is that complementary with the pecking order? Or are they substitutable in some fashion? But I want to step back. You know, Saki called them entrepreneurs. In the paper, they're producers. In my little framework, they're car dealers. they're mainly described as firms who need some liquid asset to pay their worker. I could equally think about these as households who need some liquid asset, say, to buy a house. And what they're selling is, the returns their future human capital. And that leads me to ask a question about how do I interpret variation in the risk of producers, quote unquote, trees? So in the model, Saki, I'm not sure I had time to go through this, but you have this very rich set of producers with very different trees with different risk profiles. And so some people are bringing safe liquid assets to the bank, and some people are bringing risky illiquid assets to the bank. And then they're all walking out with some mix of liabilities. And so what I'm curious about is, where are those sides of the market? I think it might be helpful to stare a little bit about the other sides of this trade. And so I just want to ask some questions. I don't have answers here. They're just proposals. I want to understand a bit, do the portfolios that the producers walk away with, how do I think about them resembling data in some meaningful way? I have no idea what the best way to do this. I did the crudest thing because I got the data very late last night, staring at the flow of funds again. But I just want to put some facts out here and ask, effectively, what's the right scope? So the first question you might ask is, well, who's buying checking deposits? So I looked at checking deposits of US depository institutions, and I asked what fraction are owned by households versus non-financial corporate businesses. In the 80s and 90s, it was very clear households owned bank deposits, firms owned a little bit. Now they're more similar. So there's some interesting time series variation. How do I think about who are transacting with banks for liquid payment services? What about the illiquid claims, which the paper interprets as time and let's call them time deposits? The flow of funds, at least the latest version I downloaded, doesn't have large time deposits separately. So this is crude because it mixes time and savings deposits. Basically, this is only a phenomena for households. Okay, non-financial corporate businesses don't own time deposits. Okay, so this mix of liquid and illiquid seems a bit more important for households than firms. When I look at portfolios of bank holdings, so I'm flipping these a bit. I'm asking, if I look at the household sector, what mix of their checking and time and savings deposits are checking accounts? That's the blue line. I get a number like 20%. Households are getting this mix of liquid and illiquid claims. When I look at banks, there's some big movement in the early 2000s, but if I kind of ignore that, it looks broadly like they mainly only hold checkable claims. Now that's first order. I'm curious, what I'm trying to ask is, what's the right scope of the model? Who is supplying these different assets to banks? Who is leaving with different mixes of liquid and illiquid claims? I'm trying to understand that a bit better. And I just think it'd be a place, some scope for the paper to really improve if it tells me, I don't know what the right one is, but if it points me a bit towards, what does this theory tell me about who's transacting with banks? And so that's what I'd like to see a little bit more of. And so let me wrap up. I think it's a nice contribution, gives us a new perspective on why the balance sheets of payment service providers look the way they do. There's a lot of richness in the paper. I'm curious to read more about the competitive version Saki described and the differences from the monopoly case, dealing with heterogeneity in the asset side and understanding complementarities on the asset side of bank balance sheets. And I think it gets us thinking more broadly about how these new theories of balance sheet transformation help us understand kind of cross-sectional or time series variation and intermediation. So I'll stop there.
Thank you, Saki. So maybe, Saki, do you want to respond first, and then we collect some questions?
No, I thought it was a beautiful discussion. Thank you, Ariel. It was very thoughtful, and I think you covered the main insight of the security creations. And perhaps something that you highlighted, and I should have highlighted myself, was that one of the interesting features of the environment is that there's a complementarity in the creation of liquid assets. So you can have, as Ariel pointed out, you could have a situation where there's an entrepreneur with a tree that is already liquid, and there's another entrepreneur with a tree that is illiquid, and there are advantages of selling all the assets to the banking system and getting and having the entrepreneur that already has a liquid asset getting some asset, as Ariel pointed out, that is already dented, that is perhaps less liquid in the sense that it's not at this maximally liquid frontier that I talked about. So there's benefits of pooling assets together, because there are better prices in doing so, or gain from trade.
Any questions from our panelists or attendees? I have a question that may be related to the next paper. So when we see in the market that the bank issues two securities, one liquid, one illiquid, the volume or the size of in the illiquid securities market will tell us something about the asset quality. So implicitly, I guess there is an assumption here that the information reflecting the volume of this illiquid market does not leak to the other market where the liquid security is traded, I guess.
Yeah, so I have a different interpretation. So the ideal thing in this environment is to do an aggregate version of what Ariel explained, which is take all the assets together in the economy, and you're going to have like an aggregate security in that economy. There's going to be different ownership because entrepreneurs and bankers have different net worth, and there's a maximal amount of liquid securities that can be created with an aggregate endowment. So what can happen there is that, you know, perhaps the entrepreneur is so wealthy that, you know, he actually owns most of the ownership of trees, so he's got to end up with some illiquid assets. So that's one instance where illiquid trees are issued. So another instance is so that occurs when when bankers are not wealthy. It's because you know, they cannot, bankers have to end up with the most illiquid tranche of the aggregate portfolio. But if they cannot afford it, they have to pay in the competitive equilibrium, they have to pay the entrepreneur with some illiquid tranche. But in other instances, when the entrepreneur is not that wealthy, and a lot of the wealth is on the banker side, there's excess liquidity. So, you know, the aggregate aggregate portfolio may be illiquid, but the person that can extract the benefits from having liquid assets is the entrepreneur. So if he's not wealthy enough, he cannot buy that. Even if the aggregate portfolio is illiquid, he cannot buy the liquid part of the aggregate. So in that instance, he will only hold liquid assets, and liquidity is wasted at the aggregate level. So that's the intuition, I think.
Saki, can I ask, I thought Ariel's questions on the last couple of slides were good about how do we think about mapping this to the data. I was wondering if you and Pierre had thought about that at all. Like, you know, like, are there testable implications that we could take to the data?
So, well, maybe Pierre wants to add something to this, but we never thought on the way Ariel was thinking about it.
Yeah,
On the demand side, we were thinking more on the supply side. And in the introduction of our paper, we present balance sheets of banks, and we do find it surprising that, you know, when you stare at the balance sheet of banks, and it's not that they're holding only loans, right? The loan portfolio is about 50% of the balance sheet. They're holding much more than just loans. They hold all sorts of bonds, all sorts of securities, government bonds, reserves. Of course, that part of that is for clearing, but we're talking about a large portion that is completely liquid. So we were thinking, well, why is it that they hold so much liquidity? It could be that it's just to satisfy payments, like some work of Ricardo or some work of my own, but we also think that liquidity in the banking system is doing something, which is it's providing a buffer so that the liabilities of the bank are actually safe, and that's important to make the liabilities of banks circulate. So we thought on that side, not so much on the demand, which is like the comparison between household and corporate. But you can also think of human capital, say, as an illiquid asset. It's simply an asset that I have more information about, or there's perhaps another, complication on top of private information, but you can think of households as just getting these liquid assets to buy houses. They cannot borrow against the homeowner, against their human capital. So you think of it that way.
Okay, we're running short of time, so we'll go to the next talk, but after the next talk, there will be a 30-minute coffee break. We can talk more then. Our next presenter is Victoria Vanasco. She will tell us about security design in non-exclusive markets with advanced selection.
Thank you. Let's see, I'm trying to share my screen. There we go. Well, thank you very much for including the paper in the program. It's nice to present to a crowd that is so interested in security design. So we're excited to get everyone's feedback. So this is joint work with Vladimir Asrian, who is also here today. And well, the motivation for this paper is very similar also to the previous paper and to many papers that will be presented today, which is this classic problem that how should an agent like a bank raise funds from outside investors to exploit gains from trade, such as financing new investment opportunities. And a friction that many people have focused on is the fact that the agent might be impaired of exploiting gains from trade if she's privately informed about the quality of her asset. And since Akerlof, we have known that these sort of information frictions destroy gains from trade. So, of course, there's a very, very large literature that studies different market mechanisms that ameliorates some of these information frictions. The common finding is that distortions from adverse selection can be minimized through cash flow retention and through the issuance of optimal securities like debt securities. The key mechanism and implicit assumption in these papers is that by retaining or not selling some of the cash flows, the agent is able to credibly transmit her information to the market. So there are ways of signaling or using this retention to screen the quality of the underlying asset, allowing an agent with a good asset that would not trade otherwise now to trade at least a fraction of her asset. What we're asking ourselves in this paper is, this result is very known, and I have papers where this is how trade is generated, but in practice, how is such retention enforced? In these papers, it's implicitly assumed that agents, either one or the other, either agents can commit to trade with only one investor, or investors can observe all her trades before extending funds. So in some sense, there's some mechanism that allows investors to ensure that the retention is retained by the issuer of a claim. In practice, we believe 1 and 2 require a lot of transparency and enforcement, because it's not only understanding what is the position of the issuer of a claim at the time of issuance, you need to monitor continuously the risk exposures, because in real world, okay, you can trade or you can issue a debt security now, retain a more junior tranche on balance sheet, and then 3 months later get rid of it. So this requires a verifiability of risk exposures. And also let me highlight that you don't only need to monitor that a particular asset is on someone's balance sheet, you also need to check that the risk exposure to this, it's not being hedged by other securities. So it really requires an understanding of the risk exposure of counterparties. And for some institutions, this may be plausible. For financial institutions that have complex balance sheets and also trade claims in over-the-counter markets, then these assumptions are put into question. Also, just to conclude the motivation, Ashcraft, Guri, and Kermani argue that, or document that complex financial innovations like CDOs enabled informed parties in the commercial mortgage-backed security pipeline to reduce their skin in the game, meaning sell some of the claims that they were holding in a way that was not observable to other market participants. And there are also legal suits related to misunderstandings on risk exposure. So there's a very famous Abacus case where the Financial Guarantee Corporation claimed that it had been deceived into believing that its counterparty would hold a particular security long-term, but instead the fund was helping select the assets and take a short position. So again, this was a lawsuit that was settled. But the point is that in practice, it seems reasonable at least to question what would happen if there are no easy ways of verifying these risk exposures. So motivated by this, we're going to revisit the classic problem of how to design an asset-backed security in the presence of information asymmetries, but when markets are non-exclusive. And what this means is that no investor can exclude a seller from trading with other investors. Within this context, we want to understand, well, what are the implications of non-exclusivity for equilibrium allocations? What securities will agents issue? What are the prices? And then we're going to compare it to exclusivity and think about, should we worry about this or not? So let me jump to the model. It's a two-period model. And there are two sets of agents. There's a seller and there are n buyers. Everyone has linear preferences, but here we're going to generate gains from trade by assuming that the seller values cash flows in the future less than the buyer. So any asset that pays in the future, we want that asset to be in the hands of the seller, of the buyer. So the seller will indeed be endowed with an asset that pays cash flows in the future, okay, at t = 1. And buyers here have deep pockets. So in principle, they have the ability to buy these assets. And the seller here can raise funds by issuing securities backed by the cash flows of her asset, okay? Cash flows are distributed, cash flows are denoted by X and are distributed with CDF G of theta, where theta will denote here the quality of the asset, which could be high or low. And here we make the very common assumption that the ratio of the PDFs is increasing in underlying cash flows, okay? So this is the monotone likelihood ratio property. It basically means that if you observe high cash flows, they're more likely to be from a high type distribution. From a high type asset, sorry. So we introduce also asymmetric information in a very standard way. The seller knows the quality of her asset, but buyers are uninformed. And they're gonna have some prior belief mu0, which is the probability that the asset underlying the security issuance is high quality. Let me now define what we're going to focus on. We're going to focus on feasible asset-backed securities. This is a standard in the literature, but let me just explain what we mean by a security. So a security here will be a function that will map the realization of the asset cash flows to some payment f of x when the realization is x. And here we're going to denote, F tilde, the collection of securities issued by the seller, because here now we have a situation with non-exclusivity. We need to take care of, very likely that a seller could issue multiple securities to different buyers. So F tilde is the collection of securities that a seller issues, and it has to satisfy the following. So this is basically a capacity constraint. And well, this one is not too important because here, because of gains from trade, you always want to issue positive claims. But this one is important, which basically says that a seller cannot issue claims above the value of the cash flows in a given state. Okay, so this is the definition in some sense of an asset-backed security. All of the promised payments need to be backed by cash flows. And then weak monotonicity, we're going to assume that the payment to the buyer and to the seller are weakly increasing in X, okay? I want to highlight, while weak monotonicity is there for tractability, the capacity constraint here is also nice because since we are in a non-exclusive setting, this capacity constraint will eliminate the possibility of dilution. So here you cannot issue claims that are not backed by assets. And this allows us a little bit to analyze a problem that is a bit orthogonal to a problem of dilution in non-exclusive markets, okay? As I will show, our results only come from the interaction of non-exclusivity with asymmetric information about the asset. So we're going to consider the following screening game to issue securities. So there's a stage one where buyers are going to simultaneously post menus of contracts. And what this means, a menu posted by buyer I, MI, it's a set of security pairs. So it's a collection of securities and their price. There's a stage two where after observing all posted menus, a buyer can withdraw his menu at a small cost, kappa greater than 0. This assumption of withdrawal, it's not important for our equilibrium characterization, but it's important for proving existence of equilibria, of this equilibrium, and I'll come back to this in the end. And there's a final stage where the seller observes all the contracts that are available, and it chooses a feasible collection to issue. Okay, so stage 1, buyers post menus of contracts and prices, of securities and prices. There's a stage in which buyers can choose to withdraw their menus. And finally, the seller observes the remaining offers and issues subject to the collection being feasible. After the game ends, all contracts are executed. So basically, a buyer I pays price PI to the seller in T equals 0 and receives cash flow FI of X in T equal 1. Okay. And we focus on perfect Bayesian equilibria of this game. So let me first, so there are only 2 frictions in this model. The first one is asymmetric information about the asset quality. And the second one is non-exclusivity in contracting. Okay, or lack of commitment. So I'm going to do 2 benchmarks where I'm going to shut down either one of these assumptions. In the first one, I'm going to shut down asymmetric information. Okay, we can think that markets are still non-exclusive. If you consider a setting without asymmetric information, this means that the buyers know the asset quality theta. Then here, the cash flows issued by the theta type seller are X. Basically, the seller issues a full claim to her cash flows. This is to maximize gains from trade. The price is the valuation of that asset, the expected valuation of that asset conditional on her type. And the payoff to the seller are given by the expected value of that asset, okay? Her full information expected value. So here, even though markets are non-exclusive, if there is no asymmetric information, the competitive equilibrium implements first best, okay? This is the first best because here the first best is to transfer all of the cash flows from the seller to the buyer, okay? Okay? So this will highlight that all of the results I will show you will come from the interaction of non-exclusivity and asymmetric information. Now, let me do a last benchmark, which is, well, what happens here when you have asymmetric information and exclusive markets? So here I'm going to show you a little bit results that we already know from the literature. So suppose that we do have asymmetric information, but the seller can commit to trade with only one buyer. Okay, so here, if someone trades with me, I know that whatever they're not selling to me, they must be retaining. Okay, so in this case, an equilibrium always exists and it's unique. There exists a threshold of average quality in this market, such that if average quality is relatively low, the equilibrium features perfect separation. Okay, and high types issue a debt security. And this debt security is priced at the valuation of the high type, and then the low type issues equity issues all of her cash flows, and they're priced at low valuation. This is also sometimes called as the least costly separating equilibrium. Okay, here because we have a screening game and we have this withdrawal stage, we also get a cross-subsidizing equilibrium when average quality is sufficiently high. Okay. So when average quality is sufficiently high, it's still true that the high type issues a debt security and the low type issues equity, okay, sells all of her cash flows. But there are 2 important differences. Here, the issuance is higher than in the separating equilibrium, so the high type gets to issue more, but it has to cross-subsidize the low type. So it receives a price below her valuation, okay? And consistent with that, the high type gets a value for her equity above her valuation. Okay, so this is important when I come to compare, but basically when markets are exclusive, we either have a separating equilibrium or we have a cross-subsidizing equilibrium. The low type always sells everything, the high type issues a debt security. Okay, so now we go back to the case we're analyzing, which is non-exclusive markets. And recall now that the seller can accept contracts from multiple buyers. So the first result that we show is that in any equilibrium in non-exclusive markets, there must be some level of cross-subsidization from the high to the L-type seller, okay? So for perfect separation is no longer possible. This is not so easy to prove, but it's very intuitive, because in some sense, if the way to separate is through retention, and retention cannot be enforced, then it has to be that, it follows that separation is not possible. The proof, it's a little bit like that. So you show that if you propose that an equilibrium is separating, what you could find is that a seller will always benefit from allowing the low type to sell her remaining cash flows after mimicking the issuance of the high type, okay? So it's important that that there's non-exclusivity. So maybe going back to the question that was asked before, here when you issue a claim in a separate market, in a market for a junior tranche, let's say, whoever you're selling your security in the senior tranche cannot identify you or cannot punish you for doing so. Okay, so they don't either, they might not be observing your trades. Okay, so the first result is that separation is no longer possible. And then what we show is that also in non-exclusive markets, there is always an equilibrium in which the high type seller also issues a debt contract with some debt level NE, but at average valuation, meaning the high type is cross-subsidizing the L type as much as possible. And then there's a junior tranche that it's issued by the L-type seller. So the L-type seller issues the same senior tranche. So here there's one debt security issued by everyone. And then there's a junior security issued only by the low type. Of course, in this market, everyone understands this is the low type. So the junior tranches are priced at low valuation. The assumption here is that if you're trading in the market for the senior tranche, no one can identify whether you're selling your junior tranche or not. Okay, no one can know whether you're keeping that risk exposure to this junior tranche or not. Okay, this is the non-exclusivity assumption. Moreover, we show that this direct equilibrium provides a lower bound on each seller's type equilibrium payoff. Okay, so now, so this is just a graph of the securities that are trading in non-exclusive markets. So we have a senior tranche priced at average valuation, and then a junior tranche priced at low valuation, okay? Moreover, more into characterizing this, we also show that this direct equilibrium is unique among all candidate equilibria in which the seller is able to issue any feasible security at some price above low valuation or at low valuation. So what this is trying to capture is the following. This equilibrium I just showed you is unique. If you suppose that the low type can always find the buyer to exploit gains from trade. So if there are gains from trade to be made, meaning if the low type is retaining some cash flows, it can always find a buyer willing to purchase them, okay? And if that is the case, which we think is reasonable, this is the unique equilibrium of the non-exclusive game. What this means also is that other equilibria may exist if buyers coordinate on not posting a given set of latent contracts. We conjecture that such equilibria don't exist, but we couldn't rule that out. But we still think it's pretty reasonable within the context that we're analyzing to think that here non-exclusivity basically allows a seller to always find a buyer to exploit gains from trade with, okay? So now after I did this, I know I said debt contract, debt contract, debt contract, so it seems hard to know how you compare these things. So I'm going to do a welfare analysis and a positive and normative comparing exclusive and non-exclusive markets to see what we learned. So here we can write, for all type of market settings, we can conceptually think of the payoffs as follows. So the payoff to the high type will deviate from first best, which is full valuation of this security evaluated at 1 and not at delta, okay? So this will be the first best payoff to the high type. We might deviate from, the high type's payoff might deviate from first best for two reasons. One is the retention, okay? This is a loss of liquidity in some sense. So if these cash flows are retained, you lose these gains from trade. And there's a second loss, which is coming from cross-subsidization. Okay, these are the two things that can reduce the welfare of the high type. So of course, the welfare of the high type, it's always strictly below first best. How about the low type? The low types payoff, it's either its full information payoff or first best payoff, and it can be even higher if there's cross-subsidization. So we can already see here that the adverse selection, what it does, which is very intuitive, it lowers the payoff to the high types and may increase the payoff to the low type. So what we show is that in non-exclusive markets, relative to exclusive markets, we can have more or less liquidity, meaning that level in non-exclusive markets, it's greater only when average quality is sufficiently high. So if we have markets where there's very high quality assets, then non-exclusivity allows for more trade, okay? More liquidity, more gains from trade are exploited. But if average quality is low, this is not the case, okay? But they always implement a higher cross-subsidy. So non-exclusive markets always feature more mispricing of claims, okay? And I'll come back to this because this is important. So while liquidity could be higher or lower, when we think of the pricing of claims, there's always more mispricing of claims in non-exclusive markets. This is just a graph of what I just said verbally. So if we think of the average quality in a market going from 0 to mu bar, so after mu1 here, the adverse selection problem is resolved and you issue equity in both markets. So that's why we plotted it all the way, well, here, I guess we did all the way to 1. So you can see that when average quality is low, there's more issuance. It's better in terms of what market generates more trade. Exclusive markets generate more trade. When average quality is high, non-exclusive markets generate more trade. But when we think of the cross-subsidy, it's always greater in non-exclusive markets. This is because it's much harder for the high type to separate, okay? So let me think about what implications this has for welfare. So buyers here always break even. So welfare in our model, it's just given by you could think of the ex-ante payoff to the seller, okay? And this ex-ante payoff depends on the average quality, which in turn determines the payoff of each type. So first, what we show is that there are 2 thresholds such that welfare in exclusive markets, it's greater than in non-exclusive markets when average quality is sufficiently low. Okay, so exclusivity is good when average quality is low, but it's bad when average quality is high. Okay, and of course, if average quality is sufficiently high, then both markets implement the first best. Okay. Now, what is the intuition? Here, in mispricing is just a transfer across agents, so it doesn't affect welfare. The only thing here that determines welfare is how much gains from trade are exploited. And as I showed you before, gains from trade are higher when average quality is low in exclusive markets, while they're higher when average quality is high in non-exclusive markets. So this contrasts with the literature that focuses on opacity or complexity, always generating more gains from trade by allowing, in some sense, eliminating adverse selection. Here, if the opacity is such that it does not allow agents to observe the risk of their counterparties, then this is no longer the case. Opacity is good when average quality in the market is high, but otherwise it's better to be able to observe certain things in these markets. Now, of course, as I said, in non-exclusive markets, there's more mispricing, but here this mispricing doesn't matter. In practice, you might think, well, mispricing might also generate incentive issues at the stage where these assets are originated. So for this, we do a very simple extension, which is we extend the model to allow an origination stage. So before trade, the seller can take a hidden action to affect the quality of her asset. And if she exerts effort Q at cost C of Q, she becomes a high type with probability Q, okay? So here, if we combine the seller's optimality condition with belief consistency, it follows that the average quality in this market will be such to equalize the marginal cost of effort with the marginal benefit. And the marginal benefit is given by the gap between the high and the low type payoff, okay? And so the result we show is that when asset quality is endogenous, the average quality of assets is always lower in non-exclusive markets than in exclusive markets, okay? What I want to highlight is that this result follows from the fact that non-exclusive markets always feature more mispricing. Okay, and what that means is that they always have a lower gap between the high and the low types payoff. Okay, so in any equilibria in non-exclusive markets, you will have a lower endogenous asset quality. Another thing I want to highlight is that in other papers, including my own, we have focused a lot on retention, and retention being an important determinant of asset quality. And this is saying, well, retention is not really what matters. What you need to think about is what's the price at which you are selling the claims that you're getting rid of. Because here, average quality is always lower in non-exclusive markets, independently of whether non-exclusive markets feature more or less retention. If I'm selling more, but those claims are fairly priced, then this should not be a problem for incentives, okay? So non-exclusivity harms incentives independently of whether it generates more or less liquidity in markets, okay? And why? Because they generate more mispricing. So if you had to think about, you know, when do we think like unobservability of counterparties' balance sheets or risks is a good thing? Well, this paper seems to say, well, this is a good thing for markets in which liquidity maybe is not that important, like secondary, you know, trading these assets after they're originated, or well, in this case, gains from trade are not too high, and the cost of putting effort of producing good assets, it's relatively high. On the other hand, you want non-exclusivity, you want some form of opacity in markets where origination effort is not such a big thing, so the cost of originating effort is not too high, or when gains from trade are relatively large, okay? So here you have to trade off situations when non-exclusive markets allow for more trade, then you have to weigh that with the fact that they produce worse incentives. When non-exclusive markets generate less trade, then they're inferior in all senses because they generate less trade and they also have worse quality assets. So just to summarize positive implications of the paper. So our paper suggests that as exclusivity, in practice, I don't think there's such a thing as exclusivity, non-exclusivity. It's about how hard these things are to enforce. As I mentioned at the beginning, many of these things end up being settled in courts. So it's about the easiness to enforce for a counterparty to keep a risk exposure. So as exclusivity becomes harder to enforce, the practice of splitting cash flows into different tranches that are sold separately in markets should become more prevalent. The amount of junior tranche retention should become less predictive of differential pricing in the market for senior tranches, but it should still be predictive of differential quality of those senior tranches, okay? So if I see who retains, they shouldn't tell me anything about the price of their more senior, if I see who retains junior claims, this should not tell me anything about the price of the senior claims, but it should tell me that those that are retaining have better quality assets, okay? If I could see this exposed. Let me highlight that this prediction is not this joint prediction is not consistent with any model of security sign in exclusive markets where the retention is used to separate or signal, because in that case, it is correlated with pricing. And in addition, the quality of assets should decrease, okay? So these findings 1 and 2 are consistent with Ashcraft, Gurria, and Kermani. Interestingly, they find exactly that. So when you look at the amount of BP's tranches that certain investors were keeping, and you observe investors that got rid of more of these tranches over the 12 months after the issuance of more senior tranches, what they find is that the amount retained is not correlated with the price of these senior tranches, controlling for all of the observables at the time of issuance, but it does predict worse quality of those junior tranches. Yeah. And then of course, the fact that, quality of assets has decreased simultaneously as we have seen more complex assets being developed. This has been shown in many papers as well. So I think I'm going to finish before, because I thought I had 30 minutes for the presentation. So yeah, more time for discussion. So what we do in this paper is we revisit a classic problem of security design with asymmetric information to study the role of non-exclusivity, which we think captures well some forms of opacity of complexity of modern markets. We show that non-exclusive markets prevent good quality issuers from separating, And this may increase market liquidity, but it also allows issuers with lower quality assets to mimic those with better assets, which worsens incentives, okay? And in the paper, we discussed our findings in the context of policies aimed at increasing exclusivity and financial market transparency, such as those that are in the Dodd-Frank. So I'm very much looking forward to our discussion. Thank you.
Thank you, Victoria, for finishing before time. Our discussant is Lian Shi from Inaudi.
Sure. I think Victoria has to unshare the slides, so I can share. Go back. Okay. Thanks very much for the opportunity to discuss this very interesting paper. I really enjoyed reading it, and I will first start with a summary of my reading of the paper. So they study security design in non-exclusive markets subject to the lemons problem, and in particular, the question they address is how market structure and specifically exclusivity or non-exclusivity matters from two dimensions. First, for secondary market liquidity and efficiency, and that in turn affects the primary market origination incentives. And so there's a lot of work that they are building on, and there are in particular, in the second dimension, there's the issue of retention of cash flows and skin in the game, and in the moral hazard for the quality of origination. But what is new and in particular interesting that they're bringing in here is they are specifically addressing a particular aspect of the market structure design, whether the sellers are able to engage in multiple contracts with many counterparties and how that affects security design in a competitive market. So they find that non-exclusive markets are very different from exclusive ones, and they characterize situations when one dominates the other. And on the more technical side, as typical in models of lemons markets, there's the usual issue of equilibrium existence and issues of multiplicity. So they adopt a three-stage on-contract posting and withdrawal game that is a micro foundation to the Miyazaki and Wilson-Spence equilibrium that usually allows to refine to a unique equilibrium that's tractable. So I'm a fan of this setup, and in particular, Saki and I have also resorted to this framework in our own research, and we think it's a very appealing setup because in particular, it also captures the market competition dimension to offer the most attractive contract also for the good quality assets while being while designing the security such that it's incentive compatible for the bad quality assets. So following Ariel's discussion, I will also use a simple mini model example to kind of illustrate how that helped me to understand the key forces in their more sophisticated model, and also to highlight in which situations exclusivity could matter or not. So, so here we have observable cash flow could be 0 and 1. You can think of this as just a normalization that the bad state is normalized to 0. And there are two types of assets whose quality is unobservable to the buyers. And so the probability that the cash flow is 1 is probability theta, and a fraction mu is the high quality asset. So I'm going to call these apples instead of cars. So there are the bad apples and the good apples, and they differ in the probability of being rotten versus normal. And the sellers are impatient compared to the buyers. So without loss of generality, that we can focus on two contracts, which for the low type, it's the market offers a price PL, and for the high type PH. And if the cash flow is 0, then definitely the sellers are going to pay the buyers 0. And for the bad apple, if the cash flow is 1, it's without loss of generality that they pay the buyers a cash flow of 1, the entire cash flow, because the market competition is going to ensure that's the eventual contract that's realized in equilibrium. And for the high types, they're going to pay amount D from 0 to 1. So 1 minus D is going to be the cash retention for the high type. So the equilibrium is going to be characterized by this problem, which I think Victoria skipped to show, but I find this very informative in understanding the problem that the market will try to cream scheme the high type asset by offering the most attractive terms to maximize their payoff, subject to the incentive compatibility constraint for the low type. So in the exclusive market, we have to offer a price to the low type that at least above what if they mimic the high type. So in the exclusive market, they're going to also have to retain this cash flow. And if that occurs with a positive probability, it's going to affect their incentives differently, as if it's in an exclusive market where they can for sure get rid of. So in the non-exclusive market, when the low type mimic the high type, by participating in this contract, they can, in addition, issue the remaining cash and obtain the liquidity immediately versus having to wait until the next period. And subject to the standard 0 profit conditions for the buyers. So a special case that I find very informative for me to understand is when the cash flow is deterministic. So in particular, if I set the low type to 0, so here the bad apple is going to be rotten for sure. The cash flow is for sure going to be 0. So this is exactly going to lead to a special case in my paper with Saki, where we also adopt the same contracting game. So what's going to happen is that when there is no cash flow uncertainty for the low type, there is this difference in whether the market is exclusive or not is going to disappear. And so exclusivity doesn't matter if we kill the randomness in the cash flow. And in particular, it's going to, and unique pooling equilibrium is going to emerge because the market is going to offer the best price for the high type. So they're just going to pull into the same contracts. And in this case, we can show that if there is very low high quality asset, the equilibrium is going to be debt issuance of 0 for both types, and they pay interest rate 0. And if there's sufficient amount of high quality assets, then we're going to be in equilibrium, that it's going to be a pooling equilibrium with debt issuance 1. So now if we set we introduce randomness, exclusivity is going to matter. In particular, it comes from the incentive compatibility constraint for the low type. So in order to satisfy this constraint, you either have to lower the price you offer for the high type, or you have to increase the amount of cross subsidized to the low type in order to increase the price of the high type. So this additional discount factor that appears in exclusive markets is going to matter for the incentives. Given the time constraint, I'm going to be a little quicker here. The other scenario here is when the high type retains zero cash, and then this constraint doesn't matter either, in which case when you have enough good quality asset, doesn't matter whether you have exclusivity or not. But in general, it's going to differ. So my example is a little bit too stark. So some continuity that they have on the cash flow is really the bare minimum to obtain more general results, to ensure that you are always in some interior amount of liquidity rather than going to the extreme. So, in terms of the comparative statics of the economy, there's a lot of discussion, and mostly on the type composition mu. Another aspect I find interesting, and I was wondering, is concerning the cash flow distribution of the two types, because when they proceed naturally to the moral hazard discussion origination, so following the comparative statics, naturally the model efforts to improve on the type composition mu. So if the sellers exert more effort, they're going to have a larger fraction of high quality assets. But alternatively, we can think of a scenario where higher effort, monitoring, etc., improves the cash flow distribution of the bad apple being more increasing the probability of theta lower bound. I'm not sure whether they lead to the same effect, because in the example, perhaps still a bit too stuck, but at least when we think about theta lower bound equals 0, exclusivity doesn't matter. When it goes to positive, it's going to matter. So it seems that there's also some non-trivial effects depending on the cash flow distribution of the low type and high type that's going to affect how the origination incentive matters in the two markets. And then following on that, so naturally, the discussion here when they model exclusivity, they are allowing the sellers to trench the cash flows that they may sell different parts of the cash flows to different contracts. But alternatively, it's natural also to think about slicing the assets, meaning that they can divide up the assets, and that introduces the possibility of quantity screening. And it's also quite standard in models on this discussion about exclusivity versus non-exclusivity when cash flow is deterministic. But it's still a possibility for sellers here to think about signaling by selling some part of the quantity. So then the question is, what is the right or sufficiently rich contract space to begin with? And then to contemplate on quantity screening. This also relates to the issue of transparency to some extent. If we think about the part where the low types wanted to sell the remaining cash flow momentously, but the high types find it unappealing, and that's how we obtain the incentive constraints. So is there a possibility that the high types can sell some slice of their cash flow 1 minus D to signal that they are high quality. So like, to me, it depends a bit on the opacity or transparency of the seller or asset identity. Does the buyers observe all contracts that the sellers engaging when they sell a slice of a particular asset to one buyer, but then if the buyers do not observe their other contract, maybe they're selling another slice to another buyer. So it seems the assumption whether buyers observe all the contracts the seller engaging is also a crucial assumption here. I think this perhaps relates to the questions Shenxing was asking earlier. Also, given in a general setting here that the buyer, there are multiple contracts. If you engage in one particular contract, does that reveal information that's useful for the other contracts? So, so the authors allude to issues of transparency, but to me it seems that the transparency part per se is not really specifically formalized on top of the structure of non-exclusivity. And I think that potentially could be a very interesting interaction in here. And perhaps to build more on that, the current 3-stage game, where the game ends with the buyer, with the seller selecting the contracts are not exactly fitting. So perhaps you may need many rounds of withdrawal and adjustment that can also microfound the same kind of equilibrium notion. So let me conclude here. Really interesting set for paper, and I find that all the characterizations very elegant and neat. And to me, in terms of expositions, useful to understand more in the elaboration of where exclusivity matters and doesn't, and also additional comparative status and some clarification on the contract and the possibility of quantity screening may be with the right assumptions that you can shut it down, but I'm curious to understand the interaction of sellers disclosing their contracts and having more transparency on their trades with different parties and in non-exclusive markets. So that's it.
Okay, Victoria, do you want to respond to Leanne's comments? And then we have some questions.
Definitely. Thank you very much. That was a very nice discussion. Let me start by the end, the issue of observability. So here it's implicitly assumed. So if you had observability and you were allowing, so it's not observability, it's about verifiability. So if I observe what you're doing and I can change my contract based on what you're doing, the price, that recovers it. That's effectively exclusivity, because I could always say, if I see you trade with someone else, I don't trade with you. So even though here, the assumption in some sense is that you can trade with other buyers and I cannot make my contracts contingent on what you do with other buyers. Otherwise you recover exclusivity. I mean, there's a paper by Stiglitz now where you can think more about disclosure and choosing what to disclose. But this is, I mean, some of the results are very similar. So it in some sense, you don't lose this. But yeah, here it's important. If you want to think about what is in practice, what the way non-exclusivity works, it has to be that either you can commit or that these things are observed. So here it's implicitly assumed. So I thought in the paper we say that non-exclusivity means that you can trade with many people and contracts cannot be contingent on those trades. Okay, so I cannot change my price based on what I do. So whether you observe or not, given this assumption, it's irrelevant, but I guess the assumption is that the way to think about this is that you cannot observe. As for the slicing, I didn't understand the comment. So here, slicing is a possibility. You could slice, you choose not to. Actually, Attar, Mariotti, and Salanier have a paper in 2011, where basically they do our problem, but instead of allowing for richer securities, they just think of slicing. And there it's very interesting because there you recover sort of the Akerlof outcome, right? So either you sell everything or you sell nothing. There's no, here what the tranching allows you to do, it allows everyone, well, everyone, only the high type it allows the high type to always participate. Otherwise, in some sense, because you cannot separate, slicing is not useful, so because retention is not a separating device. And then whether, when the security is linear on the cash flows, if you want to issue a little bit, then you want to issue everything. And if you don't want to issue, you don't want to issue anything. So it is important in some sense compared to their paper that you don't get the Akerlof outcome when you allow for tranching. But there's no sense in which you would want to slice the tranches. I mean, here, this is the optimal thing to do. And from their paper, I know that only slicing is not enough. With slicing, you wouldn't get any of these results on, retention. That you get something more like the Akerlof that we know of. I don't know if that's what you meant by slicing, though. So maybe we can talk about that. As for the asset cash flows, yeah, that's interesting. So, sometimes I have issues with that because I think changing the cash flow distribution, you're also changing what it means when you have two types. You're changing what it means. You're making the bad asset not so bad. So there's, it's unclear what you're doing, but I do think it's interesting to think, what if you can move sort of the lower bound or the upper bound on the quality, and the results don't need to go through. So it's important for this that the intuition here is that non-exclusivity generates more mispricing and it generates more cross-subsidization to worse things. So whenever you're deciding ex ante, it's hurting the good guys and benefiting the bad guys. So that's why it's always worse for incentives. If you're changing now what a good guy and what a bad guy means, then I don't know if this may not be longer the case. And we haven't analyzed this. We would have to parameterize, I guess, the distributions, but that's an interesting thing. I mean, it could be very different if it affects the lower bound or the high types payoff, and so that one, it's a good suggestion. I think those were sort of the main comments, but thanks. And really nice, like the thing you did at the beginning with the types. I like this thing of the comparison on which situations exclusivity, non-exclusivity are equivalent. That's very useful.
Thanks for the answers. Yeah.
All right, Emery has a question.
Yeah, so I like this idea of non-exclusivity. Actually, Shengxing is going to present later our dynamic paper, and we also have non-exclusivity in the security market. Sorry, the dog is barking in the background. But one thing we have, which is different, is we have this seller can commit to a subset of securities. And it's kind of a minor thing, but as a terminology, I think of that as more security design, as when the seller or some designer can basically commit to what securities are available for trading. And the nice thing here you have is that actually the buyers kind of compete for securities. They decide what are the securities that are kind of they are willing to buy. So I guess my question is, have you thought about what happens if you had a designer and the seller could commit to which securities are available? How would that contrast with your results?
So, yes. So two things.
Does that make sense?
Yeah. And I know your paper. So yes, I can talk. So yes, the first thing, so who offers the contracts? So here, if we had the seller offering the contracts, this becomes a signaling game as opposed to a screening game ex post.
No, but that's not my point. So the seller could.
No, I understand. You want to talk about the commitment, but let me split because you're changing two things.
And still, the buyer still makes the price offer. but they cannot choose whatever securities they want. The securities are picked by the designer ahead of time. You know,
Yes,
there's no
exactly.
signaling in what I'm describing. Yeah.
Exactly. But that's why. So changing who's offering the contracts when you're ex ante, I think it's equivalent. So it doesn't matter who is designing ex ante. So first, let me say, I don't know why you think security design has to be before the arrival of private information and not afterwards. So I think these are both. You know,
I mean, it doesn't look like design. That's all. I mean, my only issue is with the word design. Like, there's no design. There's competition, like competition for issuance or something.
You design a security, you choose what security to sell. So the difference between designing ex ante and ex post here is in both markets, there will be competition. The difference is that in your ex ante case, what you're doing is you're pinning down the debt level that is higher. I don't know if you have, do you have ex post participation constraints of the high type? Because if you do, I think the results are probably equivalent. But if you don't, no, you must have, otherwise ex ante, you might choose to issue equity. So usually ex ante, what you internalize the cross subsidies, right, between one type or the other. While ex post, all you care about is maximizing the high type's payoff. So while ex ante, you want to maximize gains from trade, ex post, you're sort of constrained for the.
I mean, in our setup, equity is not even, you cannot, like the high type cannot then say, I'm going to offer equity, because the designer says, here are the two securities. It's either there's debt and there is the residual tranche.
No, I understand,
And,
but when this is being designed, you could choose equity. Right?
You could choose all equity, and that, you could say there's only one security and that's equity. That's possible.
Yeah, exactly. But that's not your
typically
outcome.
You wouldn't.
Yeah, so I would have to, in general, it depends on whether you put exposed participation constraints or not. I mean, you can commit to these securities, but I'm guessing in your case, agents have to choose them exposed. They're not forced to issue them.
Yes, they can decide which one to sell.
The difference is that in your case, the difference is only what determines the debt level. So in your case, the debt level is the maximum debt level that ensures participation of the high type tomorrow.
That's right.
It's the debt level that maximizes the high type's payoff. So it's different. Mine is sort of weighing the benefits of issuing with the cost of cross.
So that depends on
your debt level will be higher than mine, but I think conceptually it's very similar what's happening. It's just that ex ante you internalize cross subsidies, exposed you don't.
So the competition in yours basically pushes the debt level to one where high types payoff is maximized.
That's the difference. Exposed, you maximize, you compete for the high type, and ex ante you compete for the average. I mean, ex ante you care about the welfare.
Yeah, the total. Yeah, so there's efficiency. Yeah. Okay.
Yeah. But also, I mean, your case doesn't have the screening.
In fact,
so I guess.
In fact,
yeah, it's much.
My conjecture was also that really with commitment to a subset of securities, like with what I call design, it really doesn't matter exclusivity, non-exclusivity. The outcome will be the same. But
if you didn't have this segmented markets assumption, I think you would either have a pooling of some debt tomorrow or a separating outcome, but you wouldn't have this tranching. This tranching that you have has to come from non-exclusivity. I don't know. If things are priced exposed, I would think the fact that you assume these markets are segmented, it's important, which is equivalent to our non-exclusivity. I think otherwise you would get you would design whatever maximizes welfare. So when average quality is high, it's some pooling debt contract, and when it's low, it's a separating allocations. That's the normal sort of ex ante security design result. So yeah, I don't.
Anyway, I don't want to monopolize it. We could go on, but
there's a question from the attendees from Jingwu Chang. His question is, have you considered extending the two types to multiple types, as in Attar et al.? Would introducing more than, I guess, two types amplify or dampen your results?
That's my husband and co-author calling me, as if he doesn't know I'm in the middle of the presentation. So the answer is, so we have thought about it. It's already very complicated to analyze because the deviations here are so large that when you add, so a continuum of types, I can't even think about it like they have in ATAR. I can tell you, for example, with 3 types or a finite types, 3, 4, that you can construct an equilibrium like the star equilibrium. So that we have done. And that equilibrium basically looks similar in the sense that you're going to have as many tranches as types. So you're going to have a very senior tranche that everyone issues. Then the high type drops out. And then you're going to have a mezzanine tranche where the medium and low issue. And then the mezzanine guy drops out and you have a junior tranche. And if you have 4 types, 4. Proving, so this is something that I don't know, I don't even know if we have now are discussing this in the paper or not, but already proving things with multiple types, it's very complicated because the set of deviations just becomes very, very large. So this is something that, you know, but yeah, you can construct equilibria that look like this with finite types. So we did it with 3, for example.
So it looks like you actually have very good characterization this equilibrium. And
yes.
But are you saying that you couldn't prove the existence? Like, what was the problem? I mean, so
of this. Well, no, the hardest thing of this, well, once you get to the point of using this technology of Natra and co-authors, which also came from Saki, so we are all talking to each other here and figuring out how to prove uniqueness. And so with this 3-stage proving existence, it's relatively easy. We couldn't prove uniqueness. We can prove uniqueness if we say, you know, all contracts have to be available at least at the lowest price, which we think it's a reasonable assumption, but we couldn't rule out equilibrium in which buyers coordinate on not posting some latent contracts, some contracts that they say, okay, this set of securities, no one allows the seller to purchase. Everything we come up with, we always are able to find deviations, so, but we couldn't prove. So the hardest thing is uniqueness.
But also MLRP may not be strong enough in this case, because when the high type drops out, the conditional distributions that are left over may not satisfy perhaps MLRP. I mean, I don't know whether that's obvious or not. But
with multiple types, you need to make assumptions on all of the exactly.
Yeah, you have to make stronger assumptions on the distribution.
And then you have to make assumptions exactly. Is high and low worse or better than medium? Right? So pulling high and low, is that better than a medium or worse? I mean, all these things, and this is with 3, no? So if you add 4, you need to sort of make rankings across these things. But what we know, we have a very strong intuition that an equilibrium that looks like ours can be constructed. You know, you have to do all these things and it's very painful, but eventually you can construct it. So,
so you mean star equilibrium, you know, the so-called star equilibrium.
The star, yeah. So you would have more securities, but these sort of mezzanine tranches and so on. It's just that for supporting each equilibrium, you have to specify the set of latent contracts that support that equilibrium. And this set of latent contracts, the more types you have, the more complicated they become. So that's where I guess we decided it wasn't worth it, but it's something that for at least 3 types, for 3 types we have characterized we have the latent contracts.
No, I mean, so such a discussion is, you know, is very nice, because I think we at least want to know, you know, like how pooling is going to occur when there are multiple types. Is it going to be as you described, like, you know, all the types go to, you know, like, you know, one trench, and then the other 2 types go to that's one structure. The other is just like, you know, between adjacent types, right? High and middle, and middle and low, like middle and low. Like, but you're saying that it's going to be that structure that, you know, all the types go to one trench, and the middle and low, and then, you know, only low. So that is the structure.
If the MLRP is satisfied, as they drop out. So you have to, I guess, have this is what Emra was saying, you have to have MLRP holds for medium relative to low, from high relative to medium, and from high medium relative to low. But yes, that we know. So yeah, I agree. So it's true that when you add more types, you don't know if it will still stay in 2 tranches forever, or if you will get richer tranches. So, I mean, if I'm honest, we had this in the paper. We decided to remove it, but it's true that maybe it's worth putting something or actually adding the subsection to show that the way it extends, at least intuitively, it seems like they will be grouped in tranches. And I guess it also produces this in tranches, which is not bad.
But it's a bit uncomfortable in terms of realism, this idea that there could be as many tranches as types, because in reality, there are not that many tranches, right? So that's kind of, maybe it's an interesting question.
But we have narrow framing also. It's like, they're like,
so with 2, it's very nice, you know, you have that tranche.
In the real world. So yeah, I think for the real world, people think like really bad, average, and good. But yeah, that's the same as explaining why we have like 5 ratings or 6 ratings. I don't know. But yeah, it's.
If I may add to this discussion, so what Saki and I find is that when you go from 2 type to a continued type distribution, actually becomes even more tractable, because there's always a marginal type that you are maximizing. So this is of course without the trenching part, but probably the same would go through in your framework as well.
Yeah, I agree. Like often, like by making the problems like seem slightly more complicated by adding a continuum from 2, you end up like taking the advantage of calculus, and things are characterized more neatly. That often happens.
It's either continuum or 2.
Either, that's how all economics, either continuum or 2.
It's either continuum or 2.
Yes, I don't know. I would have to, I don't know. To me, thinking of here with a continuum of types, maybe. It is true that in non-exclusive, like in the standard security design, it's straightforward to think of it with a continuum of types as well. Yeah, some of these.
What you will encounter, but perhaps it's tractable, and I don't know. Yeah.
I would think that will be very difficult here, because with continuum type, there's possibly like continuum equilibrium contracts, right?
Yeah.
Yeah.
These things, I don't know.
Yeah, but you know, you may end up finding refinements at work, and
I'm happy to engage in that. I don't think I need help from one of you. But
well, I have a big picture, like a question, like it's more for the crowd and Victoria. Now, like I'm using the opportunity of the 30-minute break. But so this literature, I mean, there's quite a lot of paper, quite a lot of people working on this area of security design and thinking of markets. But how should we, how should we approach the questions? I mean, should they be approached as positive economics, as like we're identifying reasons why markets work in certain ways, or more in a normative sense, like saying, well, we think these frictions are out there. They seem to be important just from casual observation, and this is how a market should behave. And if it doesn't behave that way, we're well, there's probably something jamming that market, or the market hasn't figured it out yet. Clever ways to come around, like security tranching did not exist forever, so it's an innovation from the 90s.
Yeah.
And so, well, it doesn't mean that the frictions weren't there before. It's just like sometimes markets catch up with ideas. So I don't know. I mean, because like.
Well, I can tell you mine. I'm interested. My approach is always, I think these frictions are relevant, and I'm interested in the normative, but it's reassuring that the positive results are consistent with what we see, and then you can talk about the normative implications, but which is different than observing something and saying, how can I rationalize what I observe? But yeah, it's an interesting question to see.
Yeah, and I mean normative not as in, like, it requires a policy intervention, but like not as if it requires I mean normative, not in the, it requires a policy intervention, but normative in like, there are, things are not exploited the best way they could be.
Exactly. Yeah.
I don't know.
Yeah, for example, I think your paper, Saki, could be, instead of about bank balance sheet, could be about stable coins or something. Maybe Ariel knows better what to mean by stable coins.
Yeah.
I mean, but I would answer Saki's question, I think.
But hold on. But it's nothing about coins, Shensing, because it's like coins are fiat. They're not backed by anything.
No, but the stable coin is backed by.
Oh, stable coin. Yeah. Sorry, you said stable coin. Yeah, take it back. It is all about stable coin.
I was just gonna say that, like, this is a place where there's so much regulation, and the regulations we think we understand are all kind of rationalized by thinking about very narrow slices of what these institutions do.
Mhm.
So, like, narrow banking policies that are built on Diamond-Dybvig theories of the bank, how does that interact with your kind of model, right? Or when I think about Saki's model, think about the different source of demand for assets. How does that interact with capital requirements that directly control the kind of assets banks can acquire? So when thinking about these other activities of banking, does that change our perspective on these policies? I mean, that would be the normative take, I think, is, I believe the role they are playing in your model is useful. Does that change what I think about, safe asset capital requirements? That's the approach I would tend to favor. And again, it comes from, like I sort of said, banks are these bundled sets of activities. I'm not quite sure why we bundle all of them. Maybe it makes sense, maybe not. But the regulations we study usually are usually based on theories that include just one of these concepts.
Mhm.
That's right. Yeah.
And I think that creates a lot of scope for thinking about, what are the interaction of bank activities? What do they imply for security design and regulation? I would avoid stable coins. That whole area is a mess.
But how do you?
Sorry.
Oh, sorry. Go.
No, I was going to change topic. Like now that we're in a break with Ariel, you said you had some interesting meeting with JP Morgan after your paper.
Not after my paper. No, we're trying to build out a blockchain crypto center.
Oh, okay.
Campus-wide one, and so we're pitching sponsors for money right now.
Okay, welcome back, everyone. So our next speaker will be Isaias. He will tell us about bargaining and securities.
All right. Well, thank you so much for having me. Thank you to the organizers for inviting me. In case we haven't met, I'm Isa Chavez. I'm at Northwestern Kellogg. Today, I'm going to be telling you about some joint work with Felipe Varas at Duke on bargaining and securities. So the motivation is that large corporate negotiations are rarely conducted in cash or only in cash, but overwhelmingly all of the literature on bargaining without commitment focuses on cash transactions. So if you think of a few examples, acquisitions, they're financed with shares, they acquire very often, ventures are financed. Pardon? Did someone just say something? Okay. Ventures are usually financed, equity or equity-like things, bankruptcy negotiations. This is not usually cash that's changing hands. The negotiations are over the terms of the new debt that then give you some claim on, the cash flows of the firm. And so our goal here is just to understand the equilibrium effects of bargaining in contingent payments when you have a no commitment. Just at a high level, we're going to have two players bargaining over the terms of some joint project that are the rights to which originally rest with the seller. And what's new here is that the offers are going to be made not in cash, but in a one-dimensional family of securities. So if you want to fix ideas for the moment, just think of it as different equity splits. The seller, who will be a she, is making offers to a privately informed buyer. It's by convention he. And it'll be important that the private information affects both the buyer's sort of standalone value or outside option and the realizable surplus from the transaction. The model is going to be in continuous time. So the seller can adjust her offers every instant with no commitment. And there's some work in this literature in the paper on how to formalize that. And we do essentially two things. First, we characterize the equilibrium dynamics for fairly arbitrary securities. And then we study the effects of going from a less informationally sensitive security to a more informationally sensitive security. So of course, this is something I explain much more in a pure econ audience than I need to explain for this audience, but you can just think of, you know, if you buy my company and pay me cash, I don't have to worry about what you know about the future market. If you pay me your equity, well, then I really worry. In that sense, equity is more informationally sensitive. What happens as we move upwards in that partial order to the dynamics of the bargaining? Just one thing to be clear, ironically, I suppose, for the name of the conference, there's no actual security design happening by the players. We're going to fix a space of securities they bargain on, solve the equilibrium from there, and then try to understand how the equilibrium looks differently if they were bargaining in a different security space. Now, the main force to keep in mind is essentially now that the seller is making offers in these contingent payments, she's worried about adverse selection. How does that interact with the informational sensitivity? Well, on the one hand, you might think, well, maybe that's bad for the seller. More informationally sensitive securities heighten this adverse selection concern. But there's also in the mechanism design literature an opposite insight that says, look, if I'm trying to screen you and I can offer you a payment that is more closely tied to your type, I can skim off more of your surplus. Right? It's a linkage principle type argument. That's a static commitment type argument. One of the contributions here is see how that plays out. Does that survive? Does that get overwhelmed when you can't commit to your offers? Now, in the literature, I'll be super brief given the time. There's just two things to highlight. Of course, as this crowd would know, there's an enormous literature in corporate finance and so on, contingent payments. We've seen papers today on contingent payments, large, growing, very interesting literature. Overwhelmingly, though, either static or when dynamic, looking at more commitment type settings. So that's what we're adding here. The other thing I want to promote is just, there's now a family of papers on continuous time bargaining that I've contributed to. And one thing I hope to convince you by the end is just, if you were interested in dynamics and no commitment, the particular way of writing these models is just enormously tractable. Right? So one thing I try to push in these talks is you can think of this as a workhorse model if you're interested in capturing these kinds of dynamics. Okay, so let's, what's the model? Again, we have a buyer and a seller, continuous time. This is a joint project. They share a discount rate R, infinite horizon. And the buyer is going to privately observe subtype theta that's going to be uniformly distributed 0 to 1. So I'm working in quantile space. That'll simplify some things. And it's important that that type is going to affect both the disagreement payoff of the buyer and the agreement payoff in the following sense. While they're disagreeing, so before they've actually reached a conclusion to the bargaining, the buyer is receiving some flow R times A of theta, where A is some known function. You can think of A as a mnemonic for assets in place. Right? Meanwhile, the seller is receiving a flow while they're bargaining of R times C, where C is common knowledge. So it's one-sided private information. Now, as soon as they agree, the project starts generating some random cash flows. They're going to have some present value of V tilde that's going to be affiliated with the private information of the buyer. So in that sense, the private information matters both for disagreement and agreement payoffs. It's this random value, but players are just going to form expectations. So a useful notation to have is that whereas V tilde is the random variable, V as a function of theta is just the conditional expectation. That's kind of the gross value of the project. R of theta is going to be the net value of the project. So the gross minus the assets in place in present value terms. All right, I still haven't told you what I mean precisely by bargaining in securities. So the protocol is going to have the seller making all the offers. Well, this is kind of typical in these one-sided private information games, something Victoria was mentioning on avoiding signaling motives to complicate things even further. And what's different in this paper is that the offers are being made in this one-dimensional family of contingent payments. So the offer is just going to live on the real line somewhere between alpha lower bar and alpha upper bar. And if the buyer accepts an offer alpha, then he's committing to a contingent payment as alpha v tilde, right? So depending on the offer and depending on the actual realized value of the project. A bit of notation that will come up again and again as S bar, which is just the expected payment given an offer alpha, but now conditional on the buyer's information. With that, we can build out the utilities for both players. So if they agree on an offer alpha at a time t, and the type of the buyer happens to be theta, then the buyer has received that flow Ra theta up to time t. So that's why we have this factor here. And then discounted at time t gets the gross value of the project, but has committed to some contingent payments, which leads to this expected payment, which importantly is a function of the offer and the type. Meanwhile, the seller has received a flow of RC till times t, and then from time t onwards can expect that expected contingent payment.
Can I ask a clarifying question?
Of course.
I'm a bit confused by the fact that the buyer is receiving A, so it's as if he doesn't own the asset, but he's receiving like some payment. So it's like as if he was renting. That's interpretation.
Yeah, so I'll talk about interpretation a little bit more in a moment, but think of, this is an M&A setting. You have private information. It affects both your current cash flows and the value from the synergy. So that would be the interpretation of the A, right? So that I know something about myself that affects what I get if we disagree, if we never merge, and affects what I get if we have a merger.
And it's acting both as a signal over time as well.
Pardon?
Is A acting as a signal over time or
as a can you explain what do you mean as a signal?
Well, he doesn't know theta yet, right?
The buyer knows theta.
Oh, the buyers know theta. Okay, I'm getting them backwards. Okay, sorry about that. Okay.
No worries. Any other questions on this? Happy to pause here. Okay, so we're going to have a few, I claim, natural restrictions. I hope you agree. The first one is that R is type by type greater than C. So remember, R is just the gross value of the project minus the buyer's standalone value. So really what this is saying is just there's gains from trade from every type. And we'll want it to be strict at the bottom. Now, are the gains of trade increasing, decreasing? We'll control that in some other way. It's not actually important right now. The second assumption, kind of pretty notation heavy, it's really just a non-degeneracy condition, right? We're going to assume that there's enough variation in the expected payments as a function of the offer that we don't get trapped in weird corners. So what the assumption is saying is for any type of the buyer in a one-shot game, there's a high enough offer that we can get that type to reject and a low enough offer that we can get that type to accept. And same for the seller knowing that she faces that kind of buyer. To think about it, this is sort of trivially satisfied with cash. We want some of that same flexibility in offers with a security. The important assumptions of the security really are 3 and 4, and they're kind of standard, right? I'll show you in a moment. The first one is just a kind of ordering assumption, is just saying that the expected payment increases as we increase the offer. That's almost just kind of definition of what a high offer means, right? And it's sufficiently smooth and so on. And the second assumption is that the expected payment is also increasing in the type of the buyer. Right? So it's good news. The security sort of, think of it, sufficiently monotone in the eventual realization of the project, and there's enough correlation between the type and the value of the project that is good news for the seller's payment that the type goes up. And so that's going to be strictly increasing for all offers except maybe the lowest one. And aside from that, just some regularity, some smoothness. If you want to think of it more concretely, right, those conditions on the security, you might have seen in sort of security design or especially auction security design literature. This paper by DeMarzo, Kremer, and Skripich that we rely on for some of the security notions, they show look, it's enough if you just have an S that is increasing in both objects and you have some strict MLRP, some nice densities, it follows. So to be really concrete, have a couple of examples. In the equity case, the payments as a function of offer and value are just linear, right? And here alpha would just live in 0 to 1, what share of the company we're getting. If we're bargaining in cash, then the actual payment doesn't depend on the value, and so on and so forth, right? But you can, debt, right? I'll tell you a little bit about sort of levered equity. The standard monotone securities tend to satisfy these conditions.
Can I ask 2 quick questions?
Of course.
Yes, the first assumption. So here, this is more about the no gap at the bottom, right? I mean, you want to assume that R of theta is equal to C.
We cover both cases in the paper. It's just going to simplify to stating some results here, right? If you want R of 0 to equal C, we also discuss what that looks like in the paper. Today, let's
also consider the gap case.
Let me delay that question for a moment. You'll see that even the question of what the gap is or where the gap, there's a little subtlety. Now, let me just postpone that for a moment. I believe you'll be satisfied in a couple of slides.
All right, and so one more. So do we need to actually worry about this A? I mean, can you just, think that, that's actually 0, like for any data, and just work with R? Like why, I mean, do you want A to be a function, like non-constant function of data?
So it will actually matter for some of the effects we want.
So you don't want that to be constant?
If it's constant, that'll be a special case. I think there's a lot of interesting things that for certain securities will go away.
All right.
Okay, so just briefly in terms of interpretation, again, maybe I spend a bit more on an econ audience than in this audience. You can think of this in a Myers-Makhluf world. The seller's the financier, the buyer's an entrepreneur, and then C would just be the cash required to get the project off the ground. You can think of it as I discussed with Saki a moment ago, mergers and acquisitions. The seller's a target, the buyer's an acquirer with private information on both its own assets and the value of the synergies from merger. But I don't want you to get too hung up on the labels, sort of seller, buyer, right? You can just as easily reverse the labels if you think the private information is on the target side, say. What's important, of course, is to avoid the signaling and keep the fact that the uninformed side is making the offers. And just to elaborate on that point just a little bit, the labels of seller and buyer kind of they don't mean a lot in standard models, right? You can think of flipping it. They mean perhaps even less if you're bargaining contingent payments. Say you can think of the buyer, the target, who is selling itself, is in another sense of paying an equity, buying a stake in the merged company using its own equity as payment. And then we talked only a little bit about this in the last version of the paper. Restructuring, you can think of the seller as the debt holder, the buyer as a management equity holder. Okay, so let me talk about kind of how we solve this model. And I think this will get a little bit to Teddy's question of the gap and why I wasn't maybe more straightforward on using the gap versus no gap terminology.
Sorry, can I ask a quick question? So you are restricting, is this, are you restricting that the payments must be, so could this security also involve some cash directly that is not generated by theta? I mean, is it?
Yes, that is allowed. It's one of our.
Does it allow?
It's allowed.
I see. It could be part of this S alpha theta could be some outside.
Some outside cash. I'll use that in an example in just a moment.
Okay.
Okay, so if you've seen these one-dimensional, one-sided private information models, you kind of expect a screening structure. Right? So the argument usually goes, high types dislike delay more, they accept sooner, so the beliefs of the uninformed party are truncations at every point in time, and we look at equilibrium that are Markovian with respect to that truncation. We're going to do something like that, but there's a subtlety, a difficulty that arises from the fact that we're using contingent payments, which is that the buyer's utilities are no longer quasi-linear in the offer, right? So the offer interacts with the type. Now, that messes up the usual logic. The usual logic, you'd say, high types dislike delay more than low types, but they like cash just the same. so they accept sooner. But now think if we're bargaining with equity, well, high types dislike delay more. They also like keeping their equity more. So maybe they're actually more willing to reject on net. What force wins out depends on sort of relative rates. In particular, is just going to depend on the marginal rate of substitution between offer and time of trade. So if that marginal rate of substitution is increasing in the type, then high types are more willing to trade off delay, right, than low types, and the reverse if that is decreasing. So to get to sort of Teddy's point, what does it mean for the model to have a gap? It really depends on which direction the sorting is going on. Which type is the pickiest, the lowest or the highest? And so what we do to analyze the paper is just we split the parameter space depending on whether that marginal rate of substitution is globally increasing or decreasing. So our high types more willing to reject, more willing to accept. As an example, if we're just bargaining in equity, and we call those two environments upward skimming and downward skimming. I'll be returning to this terminology a bunch, so let me make sure I don't skip it. If we're bargaining in equity, you can show in sort of a one-liner that the environment is upward skimming, so high types are more willing to reject and delay more if the ratio of the assets in place to the net return is increasing. Now, intuitively, if that ratio is increasing, that means your disagreement motive as a buyer is growing faster than your agreement motive, so you're more willing to reject. That also gets sort of to Teddy's point, where do we need, or in what way do we need the A to be a non-trivial function? Well, if you think, as it would be natural in many examples, that the net return is increasing, but you want some upward skimming, which will be important to the results, you also need some non-trivial dependence, the outside option on the type. Okay, so what we do is, having separated those two parts of the parameter space, we just sort of tailor the equilibrium notion, the search for equilibrium to that space. So if we're in an upward skimming world, which is where higher types delay more, we're naturally, because what else would you do? Search for equilibrium that screen in ascending order of the type. And so then if you're searching in ascending order of the type, beliefs are always a left truncation of the prior. And we're going to look at Markovian equilibria that have that left bottom truncation point as the state. Okay, so I said Markovian. Let me just tell you very briefly what that means so I can get to the results. Really, future play depends only on the current cutoff. And the way we formalize that is by saying that the buyer is really just solving an optimal stopping problem with the cutoff as the state, right? So the buyer is choosing a reservation offer curve such that alpha of theta makes theta just indifferent between waiting for a better offer and paying what he knows he'll have to pay given his type and the offer. Meanwhile, the seller is choosing paths of cutoffs. The way to understand that is the seller is just screening in quantity space. And then there's a final equilibrium object, this F that I haven't told you about. Basically, we're giving the seller the possibility to clear the market to make this pooling offer at a random time. Since there's going to be strict gains from trade here, the seller would get tired from skimming at some point. You know, why am I going to spend a lot of time making finely grained offers to the remaining types? I can just make the offer to the pickiest type and be done with it. And for the equilibrium construction, it's important to allow that to be random. So that there's going to be, the seller can mix, maybe weight in a Poisson way before offering whatever makes the highest type indifferent. There's, you know, given the time, I won't get into it. We have a very rich sort of set of admissible strategies. We add a little bit more structure to the equilibrium in which we can make kind of claims of necessity and of uniqueness. If we have time, I'm happy to get into it in the questions, but think of it as the value functions are sort of sufficiently smooth. Let me get straight to the results. Okay, so first, the dynamics. As you might expect, it depends, how the equilibrium looks like really depends on the severity of adverse selection. We're going to say that a static Lemons condition holds if, this is for the upward skimming case, if at the offer that all types would accept, so whatever makes the type 1, who's the pickiest type, just happy enough, at that offer, the seller would lose money, would not break even. Go ahead. Was there a question?
No, go ahead.
Okay. This is sort of what you'd expect. We have a lemons market in the static sense. That static sense lemons market is going to be pretty crucial for the dynamic market. And so the dynamics are as follows. We show that, when this marginal rate of substitution is monotone and equilibrium exists, it always has a unique outcome, and it looks like this. So if the environment is downward skimming, meaning high types are less willing to tolerate delay, or if the environment is upward skimming, but adverse selection is not severe, then trade is instant. There's no inefficiencies whatsoever. But if you have high types more willing to reject and severe adverse selection, then there's a very specific pattern of delay. So trade starts out smoothly, meaning that the cutoff, the state just follows an ODE until some critical point is reached. At that point, you have a random breakdown of trade. So think of this as we're bargaining in equity, and I've been telling Saki, okay, so 15% of the company, he says no, 14%, he says no, 13%, no. And then I say, okay, well, what about 13%? And he says, well, it's still no. And then I just keep saying 13% for some random amount of time, like I've gone totally nuts. And then eventually, all of a sudden I say, okay, fine, what about 2%? And then all remaining types of Saki say, well, yeah, that sounds like a very good deal, we'll accept. So we get a burst of trade with everyone that's remaining in the market. This critical state at which we end up at this impasse where nothing's happening is exactly the point at which the seller is sort of no longer worried about adverse selection. I've ruled out sufficiently many bad types that now I know if I've made the pooling offer, I'd at least break even. And so what that means for the passive offers is, as I sort of described briefly, they're getting more and more generous, then they just freeze for a while, and eventually we get a pooling offer. So there's always going to be, in this delay case, you get some cross-subsidization and equilibrium, right? Because the offer is whatever makes the highest type indifferent. So types that are maybe right around this cutoff are getting a very generous offer that they wouldn't have gotten if they got them separated by the trade. I think given the time, I won't be able to tell you about the proof idea. Let me just pause to see if there are any questions about the dynamics before telling you about informational sensitivity.
So what would happen if there were cash offers?
Yeah, so cash offers fits in this case, right? It's cash offers you can show end up being downward skimming. You have an instant trade. Pure cash offers.
Oh, wait. So I thought that, your comparison is going to be to Denneke and Liang. That has
okay, so sorry, let me, yes.
multiple steps, right?
Let me amend that answer. I understand. So Denneke and Liang is cash, but there's we even have an extension on Denneke and Liang in the paper, right? So it's not purely the cash. Denneke Liang, I just want to make sure I get this right. Denneke Liang, the case where they get delayed, obviously as you'd imagine, fits here, right? If you see the assumptions they make on the interdependence on costs and on the presence of a lemons market, they're equivalent to an upward skimming world.
Oh.
And so it's so to speak, through the primitives and through enough interdependence in costs, you can generate some of the same effects with the cash offer. That's more. Yeah.
I'm confused about the answer because I'm thinking of Fuchs and Skripach, where it's a cash transfer, there's a delay over time, and the price is rising over time. So bad types are selling first. So did you refer to cash only in a fixed amount, or?
You mean the answer I just gave to Teddy?
Yeah. So what happens in
who's in service in the sense is you mean the paper with entry, or
there's a paper where there's similar setting, dynamic adverse selection, you choose when to sell, and so over time worse types are selling first at a low price, and over time better and better types are selling when the market is revealing that.
So that's an interdependence in costs that is similar to this A that we have here, right?
But I'm missing to understand the answer, because the answer said there's instant trade.
No, so
you said this corresponds to,
which is also cash. If you can, through the right kinds of interdependence, get similar effects. So you can think of what we're doing is partly we subsume a lot of these papers that build in that delay in cash with offers through direct functional form in the interdependence in values, and extending that to now having the interdependence be not just through that, but also through the space of securities, and then also then being able to say what happens as the space of securities changes.
So maybe the question we can ask a little bit differently. Why wouldn't this equilibrium be replicated in cash, where you start with a low price, you increase the price, and then you kind of stay at that price for some time, and then you finally make a really good offer in cash? So that's
maybe I've misspoke. So let me clarify one more time, and maybe to tell you some about information security, I'm going to move on and we can talk about one of the questions. So there is a direct mapping from the model, right, to Denneker and Liang. And so a cash model where if you allow the seller's cost to depend also on the type in a particular way, you get similar effects, where indeed you have a cash offer that's getting more generous, then it freezes, and then you make a very generous one. So I misspoke. I mean, there's a particular sort of standard case with cash where there's instant trade. In general, I misspoke for that, right? In that the Fuchs and Scribbage paper, the Denneker and Liang, they add another layer. Remember here, the seller's cost in the formulation I gave you doesn't depend on the type. If you allow that, but make the offers in cash, you can get similar effects. And that's subsumed in the analysis in the paper. Okay, so let me tell you about informational sensitivity. Just very briefly in the last couple of minutes. The definition we use is sort of from the security design literature, DeMarso, Kremer, and Scribbage. We're going to say that a security is steeper than another, so more informationally sensitive, if the expected payments always cross from below as a function of the type. So we find offers at which the expected payment is the same, the steeper security has a higher derivative. In the paper, we have results for general kind of equity versus cash comparisons. These are sort of non-parametric steepness comparisons. Today, I'll just tell you the results for parametrized comparisons, which are maybe a little bit clearer, and they'll cover a lot of our applications. So think of this as a world where the contingent payment depends on the offer, depends on the value of the project, but also on a steepness parameter, where as we raise that, we get a steeper security. So for example, you can think of a world where we're making equity offers, but there's a fixed amount of cash that's available up front. I think this gets to one of the earlier questions. And we're only bargaining in the equity component. Then as we lower the cash, so we tighten the financial constraints, we get a steeper security. Or for another example, which I'll use in a moment, you can think of levered equity. So the buyer has some pre-existing debt D and is maximizing the value of debt and equity holders. Right? So think of this due to covenants or something like that. Then you'd get this particular function as the equity, as the security. And again, tighter financial constraints, so a higher level of debt gives you a steeper security. This is the kind of examples you can sort of have in mind. I'll be able to tell you about the delay and then an application. So let's, again, fix the security. And we're going to be measuring bargaining efficiency in a particular way. So we're going to look at the certainty equivalent delay suffered by a given type. Right? So if you think a type might trade at a random time, because maybe you're stuck in this pooling region where there's some random delay, we're going to look at the deterministic delay that makes you just indifferent between suffering that and suffering the actual random amount of delay that you suffer. And so for the comparative statics, let's just look at a range of steepness parameters for which there's always delay, right? So there's delay at the low type, and as we raise the steepness parameter, we still have delay. We show that for a lot of parametric examples, including the financial constraints examples I just gave you in the paper. Then as you increase the steepness of security, three things happen. The first is that you get less pooling. So that critical type that we get stuck on in the separation phase of the game goes up. The second thing that happens is that we get more delay for low types, more delay in certainty equivalent terms. And then the third thing that happens, we get more delay for high enough types. There's an intermediate region that might actually be indeterminate. So in general, the picture you have about what's happening to delay is for steeper securities, the high types suffer more inefficiency, the low types suffer more inefficiency, in the middle they might cross. Now we've proven this comparison for these parametrized comparisons. Even we've done numerical examples that aren't parametrized, it still seems to hold more generally. Okay, so that's just an efficiency. It doesn't tell us kind of who's better off, who's worse off. We also have some results on the buyer's ex ante payoffs that'll apply in a moment. Again, let's fix the security and look at a range of steepness parameters in which, as you move up in the steepness parameter, there's always delay. We show that there's some critical type, K prime, such that all types below it prefer the flatter security. So you can think of this kind of in line with informational sensitivity, increasing frictions and harming the informed side. And then we have some sufficient conditions under which all types of the buyer strictly prefer the flatter security. So if you want to apply that to our previous examples, we have a lemma just kind of mapping the conditions in these theorems to the financial constraints examples. We show, look, in these financial constraints examples, if you start from a level of financial constraint, think of this as a level of cash or a level of debt at which there's delay. As you tighten the financial constraints, you still have delay. So we can apply those propositions verbatim. And what they mean altogether is that tightening the financial constraints worsens the bargaining inefficiencies, or tends to, and can actually hurt the buyer. But there's maybe some heterogeneous effects in the middle. And then the last application in the paper, in comparative static, is to the quality of information, which will have some implications for the incentives for information acquisition. So let's look at our leveraged equity example, right, where the buyer is maximizing total value. And we're going to use a normal linear parameterization. So this outside option function is just linear in the type, and the synergy value is distributed normally with a linear conditional mean. And eta denotes the precision of the buyer's signal about synergy. So how sure am I about what we'll get from this merger? We show first increasing the precision, keeping fixed the level of debt, keeping fixed the fact that we're bargaining in levered equity. Just increasing the precision is equivalent to us bargaining in a steeper security. And second, if there's delay for a low level of precision, there will still be delay as we increase the precision. So adding better information to the system is, at least in this qualitative sense, not removing inefficiencies. And if you, in a sense, plug in this last result into what I showed you about delay and buyer's payoffs, it's telling you that higher precision better information about synergies can increase bargaining frictions, even uniformly, and may in fact be value destroying. So what are the ex ante incentives, right? And for acquiring information, in a sense, pretty low. Right? So we have a numerical example in the paper in which, in fact, it's uniform and pretty stark. You can see how much the bargaining inefficiencies increase when the precision is high. You can also think of this as, you know, if you want to think of the technology increasing the precision, you can also just map it into different kinds of acquisitions, right? There's some mergers, right? Say, you know, we're going to achieve cost reductions. I'm pretty certain about the value of that synergy, versus maybe together merged, we're going to expand into some markets. We're pretty uncertain you might see, and according to what we're saying, because of the bargaining incentives, a tendency for acquirers to be going into these more uncertain acquisitions, the net of the bargaining inefficiencies.
Isaias, is this a good point to wrap up, because you are a little bit out of time?
Of course. Let me just wrap up. And what do we do? We characterize the dynamics for different securities and the equilibrium effects. We've told you that there's this general theme. Steeper securities tend to increase frictions, but there might be some heterogeneity. And in fact, if you think of this static linkage principle argument in the beginning, that more informationally sensitive securities help you screen types better and extract more surplus, we see that the lack of commitment reverses that and can totally overwhelm that effect. Let me just sort of end there and leave time for questions.
We also have a discussant, so Yuan will discuss Isaiah's paper. Could you unshare your screen so that Yuan can share her screen?
Yeah, just 1 second.
Hello, everyone. Thank you very much for inviting me to discuss this very interesting paper. I learned a lot from it. So this paper asks an important question. What are the dynamics when traders bargain in securities? The literature has been mainly focused on bargaining over cash payments. But as Isaias said, when in many situations, especially in the financial markets, bargaining often happens over security payments. So undoubtedly, this is an important question to answer. The authors studied this question in a classical one-sided bargaining model. The buyer has private information about the object to trade. The uninformed seller makes offers sequentially. The seller has no commitment power, so she always has the option to revise the offer after being rejected. The game ends when the buyer accepts an offer. We have a fair amount of knowledge about this model when offers are in cash. The novelty of this paper is to tell us what happens when offers are in securities. It makes several contributions, among which I think the first one is the most interesting and important to me. This paper shows an equilibrium outcome that is starkly different from bargaining in cash. To understand the importance of this result, notice that a central topic in the bargaining literature has been the efficiency of bargaining. It has been shown that when bargaining is over cash payments, if bargaining happens in discrete time, that is, the seller can revise the offer at a fixed frequency, then the equilibrium features skimming, which means the seller lowers the offer over time to skim different buyer types. This causes delay in trade, which is inefficient because trade surplus will be discounted. On the other hand, when bargaining happens in continuous time, which means the seller can revise the offer infinitely frequently, then in the standard models with a fixed seller cost, trading happens immediately. There's no skimming, and the outcome is fully efficient. And this is this contrast between discrete time bargaining and continuous time bargaining is the famous Coase conjecture, which has been verified in multiple papers. Now, this paper tells us when bargaining is over security payments, even if bargaining happens in continuous time, if the information structure and the security family satisfy some conditions, then skimming can happen, and there's delay in trade, the outcome is inefficient. In other words, the Coase conjecture holds when bargaining in cash, but fails when bargaining in securities. Why is there such a stark contrast? the cost conjecture holds when bargaining in cash, because in continuous time, since the seller can revise the offer infinitely frequently, she can control the speed of the offer revision. And this implies the seller has to gain zero from any trade at every instant. Because otherwise, if the seller gains positive or negative from any trade at any point, then she will have an incentive to speed up or slow down the offer revision. So the seller gains zero, which implies the cash offer has to be a constant over time. And this in turn implies if there is trading, it happens at the beginning. On the other hand, with securities, skimming can happen in equilibrium in the following way. As Isaias explained, if upward skimming is satisfied, then if the security offer lowers over time, but meanwhile, the buyer type that accepts the offer increases over time, then the seller's, so the value of the offer can be kept at a constant over time, and the seller gains zero at every point and does not benefit from deviating from the equilibrium speed. So I think this is an important theoretical contribution because it speaks to the classical results and tells us when the cost conjecture does not hold and why it does not hold with securities. And I just want to also respond to Amory's question just now. Why, so when there's downward skimming, what is wrong with an equilibrium where offers increase over time? That cannot be an equilibrium because no buyer will wait for a worse offer in the future. Increasing the offer means higher security payment. The authors also show that how the steepness of the security family allowed affects equilibrium outcomes, including the length of delay, the expected payment, and hence the buyer's surplus. They also apply the results to M&A and make some empirical predictions. They show how the acquirer's financial constraint affects the deal success rate, and they point out to potential flaws in interpreting empirical results. They also show that more precise private information held by the buyer can lead to longer delay and destroy value. I think these are interesting and important results, and I have two comments. So the first comment is about the equilibrium definition. In the equilibrium definition, seller strategy is defined as an offering path, which specifies what security to offer at each point of time, and the distribution of a Markov stopping time T to offer security alpha F1, which is the security that makes the best buyer to break even. And the best buyer is required to accept alpha F1. In other words, the best buyer is required to be satisfied with breaking even and does not wait for better offers in the future. Under this definition, in the interesting case with delay, there is a unique equilibrium, which is composed of a gradual concession phase, during which the seller gradually lowers the offer and skim different buyer types, and a quiet period during which the offer is a constant and no trading happens. And finally, a jump concession at a Markov stopping time T, at which point the seller offers alpha F1. It's interesting to find such an equilibrium, and the authors do a great job interpreting the results. But given this is an equilibrium, I think defining the equilibrium in this particular way may risk ignoring other potential equilibria that are also natural to consider and are simpler in forms. When I see this equilibrium, my first reaction is there a fully gradual concession equilibrium like this? That is, the seller gradually lowers the offer all the way down until all types accept. This is not allowed in a current equilibrium definition, which requires the best buyer to accept alpha F1. This in turn implies the seller does not need to ever offer anything below alpha F1, which makes the buyer's choice self-fulfilling. So I'm wondering, what is the reason to focus on this type of equilibrium? The authors motivate this requirement by that it holds in a discrete time game. And I'm wondering, is it natural to extend this requirement to this paper's continuous time game without further justification? Firstly, does the discrete time reasoning, which implies this condition holds for all equilibria, also work in continuous time? It's not very obvious to me that it works. And actually, the literature on cash bargaining shows the opposite. That is, when this condition is not imposed exogenously, there are equilibria that do not satisfy it. So if this reasoning does not work in this paper's game, then I think one should be careful about extending it from the discrete time game. Because when we move from discrete time to continuous time, as this paper shows and as other papers show, another equilibrium condition already changes qualitatively. That is, the seller in continuous time, the seller would expect to gain 0 from any trading, and all trade surplus goes to the buyer. So it seems a little internally inconsistent to argue that even though continuous time forces all trade surplus to go to the buyer, we still require the best buyer to just break even, simply because it is so in discrete time game. So I think if it may be beneficial for the paper to remove this requirement and consider such a fully graded concession equilibrium, partly because it is simpler and may make the empirical predictions cleaner. And given the current equilibrium characterization, another type of equilibrium that seems also natural to consider is a step equilibrium with multiple quiet periods and multiple jump concessions. This is again not allowed in a current equilibrium definition, which only allows one Markov stopping time to offer alpha F1. I'm wondering, is this a little bit arbitrary to allow for a Markov stopping time for this offer, but not for other securities? And once multiple Markov times for different securities are allowed, it seems likely that such a step equilibrium could be an equilibrium as well. So I would suggest to motivate the choice of this equilibrium definition more carefully, or to relax it by relaxing the restriction on the best buyer strategy. And if a Markov stopping time for this offer is allowed, then it's convincing to also allow it for other offers. My second comment is about the result on how the steepness of the predetermined security family affects delay in trade in equilibrium. The paper shows that a security family generates delayed trade if it satisfies some conditions, including upward skimming and the static lemons problem. Meanwhile, it shows among security families that generate delayed trade, steeper security families generate higher delay under some conditions. I think these are very useful and interesting results. And I think it's important to link the two results into some, in some sense, universal understanding of how steepness affects delays. And I think the missing part is a relationship between steepness and whether the security family generates delays. it will be nice to have some statement like if one security family is upward skimming, so that it generates delayed trade, then steeper security families also satisfy the same. And actually, the paper already derived such a result in the M&A application, where the security family considered combinations of cash and equity, or equity with pre-existing debt. I think it's useful to emphasize this result earlier in the paper because it's an important part of the chain of the results. It will be nice to generalize to other security families. And if this is hard, it might be helpful to consider stronger versions of steepness, such as the concept of strong steepness used in Abhishek-Patel. And this seems hopeful to me because this concept nests your example of cash and equity combinations. To conclude, I think this is a great paper. I learned a lot from it. It makes big theoretical contributions and rich empirical predictions. And one may also wonder about other specifications of bargaining securities. So I can see there are many interesting follow-up questions that might inspire future research. I'll stop here.
Thank you so much for very thoughtful comments. Let me take them maybe in the order you gave them. So yes, in terms of the equilibrium, there's certainly some implicit refinements. I guess so the first one is about this pooling offer, and you're right, Juan Ortner has examples where this natural property of the discrete time game fails in the continuous time game. I guess this is, there's no, of course, the formal reasoning that gives you those results in discrete time uses the fact that there's real time between offers, and so it's real discount, and so you can't replicate it in continuous time, and that's sort of a general theme that you get all these additional indifferences and therefore different equilibria that maybe look funky. Right? Now, what you're raising is the fair point. Well, is this really funky or is it not? I would still say that there's something natural about it in that the pickiest type is the highest type. The skimming needs to happen anyway. And so the pickiest type is faced, right, by himself, right? So by the time you face the highest type, you know it's the highest type. So what are you going to offer him? You're going to offer him the complete information offer, right? Which would be this alpha F1. That's sort of the folksy way of phrasing the discrete time result, but I agree with you. There's no way that we know of to formally establish it in continuous time. And I think without that, there might be fully gradual skimming equilibria. I think one thing I'd note is that we give conditions in the paper in which the equilibrium might just be fully gradually skimming, right? An example would be if you can construct equilibria like that if I remember correctly, I think that if you have upward skimming, but the surplus is decreasing, right? I think we have a brief discussion at the end that's not fully worked out. You get that pattern of trade. So I think probably what I'm gathering is we need a better discussion of why we impose that, because it is true. You have more flexibility in continuous time. We're referring to the multiple Markov stopping times for offers. Yes, I think that my intuition is you can definitely construct equilibria like that too. And then it's, I guess at some point, an aesthetic choice. What do you think is the more natural equilibrium? The one thing I would say in favor of R's, right, which of course, we get uniqueness only in this restricted strategy space. I think your hunch that if you expanded the strategy space, you could construct other kinds of equilibria is true. I would still, R's is much more tractable, right? In that the equilibria, that equilibrium with multiple quiet periods, multiple jumps, the delay is just defined by a series of difference equations, which is going to be much harder to do comparative statics on. I do think they exist, right, in a richer strategy space. Now, related to the connection between steepness and upward skimming, that's a very fair point. We've definitely tried very hard to get that connection. I think in full generality, we doubt that it's true, right? That you can generally say that a steeper security preserves the upward skimming property. We haven't actually looked into this strong steepness definition, so thank you for that. The best we've been able to is in certain parametric families. Let me see. I feel like I'm forgetting some. I think the other thing I'd say is just thank you for elucidating that bit on the cache. That's sort of the basic intuition, right, on why it's hard to generate delay with cache. The way you put it was sort of really, really pristine and clear, better than I did in the presentation. I think to connect it to some of the earlier discussion we were having is just that with natural assumptions, right? Like the typical monotonicity assumptions that you'd assume on the surplus and so on in your run-of-the-mill model, if you put in cache in our model, it's not going to give you delay, right? What you can still use all the proof techniques that in our model to sort of solve more quickly and more directly things like the Fuchs and Skripach, things like the Denneker and Liang and continuous time. But there's, of course, how do you square those things? Well, their assumptions are not literally ours, right? There's other flexibility in the functional forms, in particular on the cost of the uninformed side, that could still allow you to do the sorting. Okay? Related to sort of yes, intuition, if the seller's cost depends on the type, right? Maybe there's still a way in which you're kind of left at a constant payoff, right? While you're screening through types. Anyway, so no, thank you very much. Very useful comments. I really like how you phrase these sort of, especially that cache comparison. We'll for sure we'll take that. Thank you.
Saki, have a question?
Yeah, so it's a very big picture question / comment. So you mentioned that this paper is not about security design, but you could think of time as being security design. So there's nothing special about time, right? I mean, it's, you could think of the problem as being set up as time zero, and time as discounting as just shrinking the portion of the security that we're trading. I bet there's an equivalent reformulation. So now I see immediately the response, because if you to the cache transfer, because we know that in a standard Akerlof problem, you cannot signal with quantities. And if you think of time as just shrinking the quantity of trade, then there's no point in waiting because there's no signaling with quantities. But it would be nice to make a connection between these models with dynamic incentives and security design as thinking of time as shrinking the size of some amount of trade. And I think what your different securities are doing is just changing the speed of gains from trade in some sense over time.
Right.
Or how gains of trade change over time.
I guess the clearest mapping would be, if in a commitment setting, if you could directly control the amount of shrinking. That's kind of what you're thinking.
Yeah, I'm thinking of time zero. Yes, I'm thinking of a time zero. I commit the time but I bet this Markovian solution's got I bet they're dynamically consistent.
So, can I add to this? Because in my non-exclusivity, we also think that we thought, could it be that you could think of this dynamically? And I think one thing that is very different, Saki, is that it is true that it's a different security, but also by the time you trade that security, some types are not in the market. While in the static case, that's never the case. So this is do you see what I'm saying?
I do see what I'm saying, but I don't like I don't find the answer convincing, because the fact that types are dropping, you can interpret it as signaling. They don't as incentive compatibility. They did not want to trade at future dates. It's true they have dropped of the market, but it's not that different. It's because they traded at a different time, which is at a different contract in some sense. So I'm not convinced by that answer.
I mean, I'm just saying that the things that if you try to implement things dynamically, it's not necessarily the same because of this, because you have to take care of, when then a second later, maybe if you do it with commitment ex ante of all of the securities, maybe that's the same. But without commitment,
for 3 weeks of.
Exactly. The problem, I guess, what Victoria's pointing out is you respond later on to the fact that those types are not in the market. Right, and so that's so you can't implement that commitment solution. So with commitment, I see sort of Saki's kind of mapping, and I think some of the incentives or some of the dynamics, right, the inefficiencies might still be there. We haven't been able to solve the commitment setting. I think with the non-quasi-linear, it gets pretty dicey. But I think some of those forces are there, and I think maybe. I guess it's dicey to borrow that intuition without fully solving the model, but I think you're correct, right? That there's a lot to be gained from that in kind of explaining what's going on.
All right, sorry to cut short your discussion. So we're running a bit short of time. So let me just move on to the last presentation. And thank you for staying until the last talk. So in this paper, Emery, Kathy, and I are interested in sort of security design in a dynamic environment. So the title of the paper is Dynamic Asset-Backed Security Design. The paper is motivated by some empirical observation, which is first, in the recent decade, we see a rise of sort of non-bank or financial intermediation or market-based financial intermediation. When we look at non-banked financial intermediaries, they do a lot of trade in the asset market. And when they own an asset, they also borrow against, say, the value of the asset to generate some additional income. And this form of financial intermediary is taking an increasing share in the whole intermediary sector. In 2018, the size of non-bank financial intermediaries is bigger than the traditional banking sector. So that's one observation. The other observation, which is closely related to non-bank financial intermediary, is securitization. This is sort of the channel through which they use the asset or borrow against the asset value. Through securitization, intermediaries can tranche the cash flow or the resale value of the collateral asset, engineer them into securities, and so then that allows them to raise funding through contracts like a repo contract. The size of the repo market is very big. Also, securitization is related to additional financial instability, as we saw in asset-backed commercial papers market. Motivated by these observations, we want to understand, how we think about this kind of intermediation through security design to endogenize the space of securities. So what we do in this paper is we study this new form of liquidity transformation by looking at dynamic optimal security design, where the underlying asset is a long-lived asset, so that the resale value of the asset would play an important role. And we found that the optimal security would resemble this popular contract, the repo contract, in some way. And the model or this theory of security design in a dynamic environment has a notion of financial instability. The instability works through the interaction between the resale value of the asset and the liquidity of the securities. So that's like the new notion of financial fragility. And then what we found is that when we allow intermediaries to design securities flexibly, this kind of financial fragility can be mitigated or eliminated. So that's sort of our finding. Before I jump into the model, here's just a summary of the related literature. So we look at an environment with adverse selection, and we look at the adverse selection in a dynamic environment. So in that sense, it's related to the literature about dynamic feedback in a lemons market. What is different in our paper is that we look at, we try to endogenize the security being traded in our market. So we look at security design in a dynamic adverse selection problem. And we applied the model to understand liquidity creation and financial intermediary. As you will see, security in our model sort of plays a role of medium of exchange in some way. And the model, the model also have something to say about the value of collateral asset and how that interacts with financial stability or fluctuation across over time. In that sense, it's related to the boom bust cycle literature and financial friction. Okay, so the model. So we're looking at a discrete time model, infinite horizon. So for the environment, the security problem, kind of, we can think of the security design problem as in within a period static environment. So the environment in the static, within a period is pretty standard. So let me first describe this environment within a period. So there are two types of agents in our model. We call agent O, who owns this collateral asset. And this collateral asset in our model is long-lived. That's the sort of an important assumption. Then the second type of agents are what we call agent I's. They will be providing liquidity to agent O. Agent O will potentially use the long-lived asset as collateral to borrow from those agent I's. Okay, the reason why agent O would like to borrow is that there is some gain from trade. So the gain from trade is the following. Agent O would value the funding supplied by those agent I's because per unit funding from agent I generates more than one unit of sort of private benefit to agent O. That private benefit is denoted Z. So there is always gain from trade when agent O can get the funding from, agent O can get funding from agent I. There's always social surplus from this kind of transaction. The problem is when agent O would like to get the funding, he has to issue securities as a means of payment. And the security requires repayment. The problem is that the agent O's promise to repay those securities is face some limit commitment issue. It's not those promise to repay is not enforceable without any collateral asset. So that's why agent O would raise funding through the sale of asset-backed securities. By securities, we just mean claims on the incomes or the resale value, as you'll see, of those long-lived collateral assets. Okay, so basically, agent O would like to issue securities to pay for those funding or intermediate inputs from the agent I's, and because agent O values more those intermediate inputs. Okay, now the important element of our analysis then is the collateral asset, against which we'll issue security. We assume those assets are long-lived. The asset will pay at the end of each period some dividend payment, ST. This dividend payment is random over time. And in the beginning of a period, agent O would only know that this end of the period payment follows a distribution. So, but the distribution could be following a bad distribution or a good distribution. So in this presentation, we assume the realization of the sort of the signal about the dividend payment, or to say the quality of the dividend payment at the end of the day, is IID over time. So the asset quality is IID over time in the presentation. In the paper, we also allow the quality to potentially persistent over time. Okay. Now, the asymmetric information arises because in the beginning of the period, agent O, the borrower observes the signal about the dividend payment, QT, but the other agents in the economy, agent I, the lender, does not. Okay, now the asymmetric information matters because the borrower's decision to exchange the asset-backed security for those intermediate input, or to say the decision to sell the asset-backed securities depends on the information, but the price of the security is not contingent on the quality. And that induces a standard adverse selection problem. So in our model, in some way, the adverse selection is quite minimal because the adverse selection or asymmetric information only emerges within a period. At the end of the period, we assume the asset quality, if the asset quality is persistent, and the dividend payment will be revealed to everyone in the economy, including the lender. So the adverse selection only would show up within a period. Now, because of
about that, so basically you have it only in one period, or the quality evolves over time. The quality of the
quality. So in the talk, we assume that the quality this period is uncorrelated with the quality in the future. It's IID, and in the paper we allow the quality to follow a Markov chain. So if you observe the quality at the end of the period tomorrow, there is a chance the quality remains the same, but it could change a little bit. Follow the Markov chain. Yeah. Now, because there's adverse selection on asymmetric information about the asset quality, that makes the security design problem important. So by security design, we just mean that agent O can issue potentially a set of securities backed by the collateral asset. Remember that the collateral asset at the end of the day will generate some dividend payments, say S. In addition, the collateral asset is long-lived, so there's a resale value of the collateral asset, phi, that we call phi. In the case of IID, phi doesn't depend on the signal, right? Phi is just a resale value. Now, the security will be backed by the asset. In a dynamic environment, it means that the total payment of those securities in the design in a state where dividend payment is S and the resale value is phi cannot exceed S plus phi, the cum dividends value of the asset at the end of the period. So for each security in the design, say Yj, we will look at an environment where there's a market price, say for that security, and based on this price, agent O, the borrower, can decide how much security to sell. So the quantity that the borrower supplies to the market will depend on his information Q. Now, right. So, and by security, so by optimal security design, we mean that this borrower would choose a security design before he observes a signal at the beginning of the day to maximize his to maximize his expected payoff. So what is his expected payoff? We denote, say, this expected payoff from owning a collateral asset in the beginning of the period V. It will have essentially two components. One is just the autarky value of the collateral asset, say S plus phi, but we integrate over the possible realization of different realization of S, and there are two possible signals. The low quality signal happens with probability lambda, and the high quality signal happens with probability 1 minus lambda, right? So that's one of the components in the value of the security. This value of the asset, this component doesn't depend on security design. It's just the autarky value. What security design affects is the gain from trade from selling the security. Given a set of security, say Yj, then for each type of security J, the borrower can decide whether to sell the security or not. That sales decision depends on his signal, whether the signal is high or low. Then, conditional on selling the security, the gain from trade for the borrower is the following. Now, the borrower gets Q units of funding. The marginal value of those funding for the borrower is Z. So that's what he gained. What he loses is just the sort of the payment enforced by enforced payment by the collateral, and the enforced payment is Yj. So the gain from trade is this. So what's crucial is Q, the price doesn't depend on the information. The price doesn't depend on whether the information is L or low or high, but and then the sales decision would depend on that. Okay, we will talk more about the security design problem or the liquidity of the market and the lemons problem later. But the reason why this is sort of this problem is new or interesting is that essentially that the resale value of the security enters the design, and then the security design that's affected by the future resale value would also feed back to the resale value of the asset. Now, suppose we denote the resale value of the asset phi t at the end of the period t. We kind of are looking at an analogous right environment. So the resale value of the security will depend on agent O's value of the security, because agent O at the end of the day will have enough sort of budget to buy back the asset as long as he's willing to buy back. And then this resale value at the end of period T will depend on the value of the collateral asset in the beginning of the next period multiplied by the discount factor. Now, we know that this value includes both the autarky value of the asset and some potential gain from trade. So that's already, we can already see that the resale value is above the autarky value. And this premium on the resale value will depend on the liquidity of the securities market in the future, because VET plus 1 depends on whether those gains from trade will materialize or not in the future. And this is where sort of the dynamic feedback between security design and the resale value of the asset will come in. And that's kind of the focus of the paper. Okay, so now let me summarize the model setup just by looking at the timeline of our model. And within a period, in the beginning of the period, before agent O observes the asset quality, he designs the security. After that, well, he designs the security to maximize the collateral assets value. Then after that, the agent O observes the asset quality. Then he goes to the securities market. Given the price of those securities, he decides whether to sell a securities or not to obtain the funding and that generates some private return. Then at the end of the period, repayment of the security takes place. The asset quality, if it's persistent, is revealed. The dividend payment of the asset is revealed. And the owner of this agent O of the asset would like to buy back the collateral asset at the market price phi at the end of the day. Okay, so that's what happens within a day. And the link over between periods is through the resale value, because as we showed, the resale value phi will depend on the future security design and the liquidity of securities market in the future, which in turn affects the liquidity potentially today. Okay, so that's the model setup. Now, for the rest of the talk, what I'm gonna do is we'll first sort of review the liquidity of each potential securities. Now, this matters because then foreseeing that issuing different type securities will generate potentially different returns, because some securities liquid, some securities are not liquid. In the beginning of the period, those expectations will affect how the owner of agent O designs the security. Then after that, we'll talk about the notion of financial fragility in this environment. And then after that, we'll talk about security design. And then we'll talk about how we interpret the security design. Okay. Now, as in, say in Victoria's paper, and also similar in Saki's paper, here we kind of are assuming that when this designer issues multiple securities, these securities are traded in separate markets. In that sense, it resembles some over-the-counter market. where if you issue multiple securities, they are traded in segmented market where sort of buyers of those securities in different markets do not communicate with each other. Then in each securities market, we assume there are multiple investors matched to, say, each borrower. Those investors or agent I's in each of those markets can sort of can make simultaneous price offers. So there's kind of Bertrand competition between those investors. They offer those prices regardless of asset quality. So because they don't observe the asset quality. And then because of Bertrand competition, the price of a security will reflect the investor's expected value of those securities. Given the price, then agent O, the borrower, decides whether to sell the security at that price. And his sales decision will depend on his information. And yeah, and because there's no communication across markets, whether, say, an agent O issues a security is not in one market does not affect decisions in other markets. Okay, so that allows us to look at the liquidity of each submarket where a security is traded separately. Now, let me just briefly, this part is kind of standard more or less standard Akerlof-Lemons problem when we look at an individual securities market, but let me just anyway, briefly go over that. So if we look at a single, the liquidity of like a submarket where a particular security is traded, whether the security is liquid or not will depend on the reservation value of those agent I's over the security. If the quality of the security is observable to agent I, then his reservation value will just reflect the information. That's the reservation value of the those agent I's, the lender. The borrower's reservation value under perfect information is always below the lender's because borrower knows when he gets the asset, he gets an additional private return, Z. Okay, so that's why under complete information, there's always gain, there's always trade in the market, trade always takes place. And because of Bertrand competition, trade will take place at a reservation value of the lender. In this case, if the asset quality is high, then the reservation value will be EH. If the asset quality is low, it's similar. Now, what is different under uncertain quality is that the borrower still knows the asset quality, so his reservation value will be contingent on the quality, but the lender doesn't know directly the asset quality, so he can only form an expectation. So his reservation value would not depend on the signal, the information. If he expects the market is liquid, meaning both high and low quality security will be circulated, his reservation value will be just a weighted average of these two reservation value. Now, when is the security liquid? That's when the reservation value of the borrower is always below the reservation value of the lender, regardless of the borrower's information. Because through Bertrand competition, the lender is willing to offer his reservation value. Then as long as the reservation value of the borrower is always below that price, the borrower is willing to sell. Then the market is indeed going to be liquid. The problem arises when this sort of most optimistic reservation value of the lender is below the reservation value of the high quality seller. In that case, the market breaks down. So that's basically the two scenarios in this environment in terms of the liquidity of a security. Now, it turns out then whether a security is liquid or not will just depend on a summary statistic, which is the ratio of the value of this low quality security over the value of a high quality security. So this ratio represents how sensitive is the value of the security to information. If the ratio is very close to 1, it means the security is not very sensitive to borrower's information. If the ratio is a lot less than 1, it means the information matters a lot for the value of the security. Of course, then
Sheng-Feng, you have like probably 10 minutes. So
yeah, thanks. I know. So now so this ratio if this this ratio is above certain cutoff that depends on the gain from trade Z, then the market indeed will be liquid, and the borrower will be willing to sell the security. If the ratio is below this cutoff, the market will be illiquid, and only low quality security will be circulated. So that's the liquidity of a particular security. Given this information later, then the designer can choose the security design to maximize the expected gain from trade. Now, before we talk about security design, let me just review our notion of financial fragility. Here, just to highlight the notion of financial fragility, we focus on an environment where essentially there's no security design, meaning the borrower can only issue a pass-through security backed by the whole collateral asset. So then here, we can, here, the reason why there may be, in this dynamic environment, there may be multiplicity is essentially is that the resale value of the security will affect the liquidity of the securities market. Then that's going to feed back to the resale value. Now imagine that the securities resale value phi is high. Say we call this pooling price because the security is liquid and the resale value is high. Now if the resale value is high, then this pass-through security, the liquidity of this pass-through security will be characterized by this quality ratio, like this R, which is the ratio of a low quality security over the ratio of a high quality security. Now, notice when the resale value is high, phi is high, then naturally this ratio will be close to 1 because the resale value doesn't depend on the information, and when the resale value takes a bigger fraction of the total value of the security, the security will be less sensitive to information. Then that will justify that this expectation that, justify this high value of the asset. Remember, we say the value of the asset reflects not only the autarky value of the asset, but also the liquidity of the security. Now, if I expect that in the future, the security is liquid, then the resale value will be indeed high. Then that justifies that this ratio is above this critical cutoff. Then indeed the market will be liquid. And so this is the source of multiple equilibrium. If I expect that in the future the market is illiquid, then the resale value will be low because the liquidity premium in the asset price will be low. Then that's going to affect this quality ratio because the asset will be more sensitive to the information about dividend payment today. Then indeed the security will be potential. So through this channel about how the resale value affects the liquidity of the market, we can show that there exists multiple equilibrium when we don't have sort of more flexible security design. I'm gonna just skip this illustration because it's kind of more or less straightforward. And now what we then do is that we talk about security design in this environment. By security design, remember, we mean that taking the resale value of the asset phi as given, then the issuer can design the security for a particular period. So not surprisingly, just like in Victoria's paper, when we assume that information friction is severe enough, similar to here, like in many security design paper, the equilibrium security design is kind of standard. So there will be a debt-like tranche, and that debt-like tranche will be liquid, and there will be an equity-like tranche. What is sort of slightly different here is that this debt-like tranche, the size of the debt tranche will depend on the resale value phi, and the resale value is endogenous, right? It depends on the future security design, and so this is why it's not ex-ante obvious why when we allow security design, we will eliminate or mitigate financial fragility or not. Now, but anyway, so given the resale value, the security design looks like a standard debt equity tranching of the cash flow of the asset. When the information friction is severe enough, of course, is severe enough, this security design is non-trivial. And the way we pin down the security design is to find the cutoff in the face value of the debt, delta, such that at the face value of the debt, the incentive constraint for the high quality seller in terms of selling the debt tranche or not is exactly binding. Okay, so that's the optimal security design given the resale value. Then what we show is that given the security design, we can sort of close the economy by solving for the fixed point between the resale value and the security design. And it turns out that when we allow security design, then there will be this multiplicity that I just described that's induced by the dynamic feedback between the liquidity market and the resale value will kind of be mitigated in the sense that we will always get a unique equilibrium. So here I'm just plotting the mapping between the resale value of the asset today and the resale value of the asset at the end of tomorrow. The reason why, there's a nonlinear mapping is that the resale value of the the asset in today at the end of tomorrow will affect the liquidity of the security. And that's why there's a curvature here. When the resale value tomorrow is low, then it makes it harder to issue debt-like tranche, and then that reduces the resale value today, at the end of today. Okay, but in the end, the mapping becomes, unlike the mapping between these two prices without security design, where there's a kink, now there's a jump, now the mapping will be continuous and actually, I think, quasi-concave. So then in the end, we can show that there will be a unique fixed point when we allow security design. And that's why sort of through security design in this dynamic environment, we get a unique equilibrium. I think I have 2 minutes left. Let me just use the two minutes just to describe what you think is an application of the security design. Remember, we say the liquid securities in the security design is basically a debt tranche. But we think in this dynamic environment, there's more. It's more than that. It's more than just a debt-like tranche. It's also a short-term debt. By short-term debt, we mean like the collateral asset itself is long-lived, but then the borrower find it optimal to issue a short-term debt backed by the dividends of the long-term asset at the end of the day and the resale value. In that sense, it resembles a short-term repo contract. What makes it even maybe more similar to a repo contract is that the borrower, as we showed before, will have incentive to buy back the collateral asset at the end of the day, because the borrower would like to use the collateral to finance, to issue new securities in the future to generate more gain from trade. And that's, again, kind of another angle through which it looks like a repo contract. And okay, so and we think, and then we use this sort of interpretation to look at the determinant of the terms of the repo contract. In the paper, we allow the quality of the underlying asset to be IID or persistent. We think that maps to potentially two types of repo contract. When the quality is IID, we can think of the repo contract as being backed by high quality collateral asset, where the asymmetric information is not about the asset quality per se, but maybe about some short-lived information about the borrower's liquidity need. And then we can talk about, we can characterize how those private information about the borrower's liquidity need affects the terms of repo contract. And then when the quality is persistent, we think that can be, our model can have something to say about the effect of persistent quality information on the terms of repo contract and how that affects, haircut of the repo, things like that. Okay, and in the previous version of the paper, actually, we also talk about whether we allow like issuer to design the security period by period, or only allow them to issue security with some probability in each period. When we allow them only to change the terms of the sort of the security with some probability, we show that security design would not necessarily eliminate multiple equilibrium. And then, yeah, so we think that's a potentially important, another potentially important application, which is that when the contract term is rigid, how the fragility of the financial market affects the design potentially. Let me just to wrap up, I'm running out of time. So here we show in a dynamic environment, there's potentially financial fragility, but when we allow flexible security design, the financial fragility can be eliminated or mitigated. And the implementation of the optimal security design can be mapped in some way to repo contract. So then we can use the model to understand the repo market. Yeah, so let me stop here. Okay, so my discussant is Teddy Kim.
All right. Thank you, Sheng-Sheng. So I'm happy to discuss this paper. So first, some disclosure. So when Sheng-Sheng asked me to discuss this paper, so I was happy, but I took the invitation not because I have any expertise in on security design, but because I just wanted to learn about the literature. And so I'm not going to give any big picture comments or suggestions. So I will just focus on illustrating. So see this, so this is going to be illustration by me. It's not going to be the kind of discussion you want to see. But I think that this is a good exercise. And also I'm not going to use any so this is going to be very similar to what Ariel did in the first talk. So I'm just going to strip down the model and just illustrate what's going on in a very simple environment, in the simplest environment. Okay. All right. So what do we have? So there's a market, but suppose there's just a one owner. So this guy has a some asset, and then this one has some linear production technology. So what it does is that whenever I get one, I can actually transform that into Z. So they don't talk about where this comes from. Suppose that you have this sort of technology. Okay, so this is a very simple way to create gains from trade. Now, but the problem is that I have this technology, this nice technology that guarantees gains from trade, but the problem is that I need funding, and the funding can only come from the outside, from the market. So what I can do is only to sell my own asset, but the asset is long-lived, so it has two components. So in each period, so the asset or the tree gives me some dividend, or so it's current payoff. And then at the end of the period, I can also sell it to the market and then can get some price. And because this is the dynamic market, so this is an important feature in this paper, that this is also going to be endogenous. Okay, but for now, let's just take this as given. So now you add this simplifying assumption that financial markets are competitive. So what this does is that the maximum amount this owner can raise is equal to, not the maximum, this is equilibrium amount this owner can raise is equal to expected value of this asset. So which is going to be that effectively it's going to be about S and V. Okay, so again, I'm just doing the theoretical exercise. So whenever we have adverse selection, we begin by looking at the case of complete information. So what about if there's no adverse selection? Okay, so then what happens is that, well, there are always cases from trade and there's no asymmetric information. So there's going to be trade. Okay, in particular in this context, so the owner always prefers to sell her asset. In a sense, so you have an asset, you just sell it to the market. Then what happens? Well, if you don't sell it to the market, you don't do production, so you only get S plus V. That's what you get when you just retain the asset. if you sell this asset to the market, you can raise this much S plus fee or phi, and then because you have linear production technology, this is how much you can get, and obviously Z is larger than 1, so you always want to sell your asset. Okay, well, and then because this is dynamic market, you can also endogenize this fee, so it's infinite horizon, right? So at the end of the period, so if you sell this as so this is this recursive formulation. Okay, so there's a discount factor. So we are in tomorrow. Tomorrow you are just going to sell it to the market, and then you can get this much payoff. And then we have this equation solving this. We get this cross-form solution for this price of this asset. Okay, and so there's just this maintained assumption that the discount factor cannot be too large. It must be less than 1 over Z, and this is just to make the problem non-trivial. Okay, I mean if this was the owner is too patient, the owner will just never sell the asset, and then nothing is going to happen. But it's not an important assumption, but it is there. All right. So what about there's an incomplete information, or in other words, there's an adverse selection. Okay. So for simplicity, so I'm going to actually just look at the deterministic payoff case. So here, so in each period, the asset quality is either low or high, and it's going to be low with probability lambda, and it's going to be high with probability 1 minus lambda. Okay, if it's low quality, it's going to give SL to the owner, and it's going to be SH if it is the high quality. Okay, so again, in the model, this is much more much more general, but let's just look at the simplest case. I'm going to also assume that the asset quality is IID over time. So what this does is that we're at the end of the period, where it doesn't matter whether your quality was high or low in the previous period, because the quality is going to redrawn tomorrow. Okay, so what this does is that like this price at the end of the period asset price is independent of the current period quality. Okay, well, so first, when can you have the pooling equilibrium? Right. So in the pooling equilibrium, or so if you suppose you're an investor and there's an asset and you don't know whether this this asset it has the low or high quality. If it's low quality, which occurs with probability lambda, you effectively the value of the asset is SL plus V. And if it is high quality, then the value of the asset is SH plus V. Okay, so the total the unconditional expected value of the asset is equal to this term. Okay, now there are two types, low type and high type. Well, low type is always willing to sell her asset, because if the low type does not trade, she only gets SL plus V. If she trades, then this is how much she's going to get, and she also applies this linear production technology. Okay, so clearly this inequality holds. For high type, it's not always the case, because the left-hand side is the same, the right-hand side is higher. Okay, so I mean, this is like very intuitive thing that you have the high quality asset where you have higher reservation value. Okay, so you are less willing to sell. So in pooling equilibrium, we still have to have this inequality, and if you do some algebra, you can arrive at this condition. Okay. Well, you can also have a separating equilibrium, where in the separating equilibrium, right, the expected value of the asset conditional on trade is just equal to SL plus V. Okay, so I mean, it's just obvious that well, so it's something like that. You make an offer, if it's accepted, where there is the low type, so this is what you're expecting. Okay, well, again, so low type is always willing to sell her asset, because this is the price she gets. And then, linear production technology, which is larger than the retention value of the asset. Okay, high type. So this is separating equilibrium. The high type should not be willing to trade. That is equivalent to this inequality. Okay, so this is the retention value, SH plus V, must be larger than the payoff he gets in case he just sells the asset at this price. Okay, so again, arranging the terms, we arrive at this inequality. Okay. Now, so looking at, so in terms of phi, so we have this figure. So if phi is above this phi lower bar, we can have pooling equilibrium. If it's below the upper bar, then we have separating equilibrium. Okay, so here, of course, here we have equilibrium multiplicity. Okay, so we have pooling equilibrium. We also have separating equilibrium. Okay, so you see why this is the case? Well, it's because again, here it depends on the the market perception about the trade. Okay, so if the market believes that the high type is trading, the price is higher, then the high type is more willing to trade. The high type can be willing to trade. If the market does not believe that the high type is trading, then the price is low, and it can actually induce the sell. It can provide it maybe so on with that low price, the high type may be willing to not trade, right? Well, but they actually do this thing. So applying the Wilson's equilibrium selection in the following sense. So suppose that consider this explicit competitive bidding. So in the sense that there are multiple investors, they are sort of kind of engaged in auction. Okay, so now and then we actually can see that in this region, separating equilibrium is not going to survive. And the reason is that suppose that we are here. Suppose we are here and we are looking at the separating equilibrium. The price must be equal to SL plus V. So there are multiple investors. So you assume that all those guys bid SL plus V. Now look at what individual bidder or investor, and that suppose that this guy deviates to this price. So this is unconditional expectation minus epsilon. Then this price is going to be accepted by the high type because now the high type is willing to trade. And then, so if that's the case, the guy who made this bid is going to get a positive payoff. Okay. So this way you can, this separating equilibrium is going to unravel if you actually think about this explicit competitive bidding. Okay. So in the static environment, where in a sense, there's no equilibrium multiplicity if you apply the Wilson's selection. But so this is the part where the Strengthing talked about financial fragility, and effectively that's about where if you actually take this into the dynamic markets, where this equilibrium uniqueness is not going to hold, and the reason is the following. So suppose that there's this. So suppose we want to endogenize this phi. Okay, so if it's pooling equilibrium. So what happens is that, this is discount vector. Whether you are the low type or the high type, you are going to trade. You are going to get this price. And at this price, now you apply the linear progression technology. Okay. So then, this is going to be the equivalent price in pooling equilibrium in dynamic markets. If you do the separating equilibrium, where the difference is that, if you are the low type, you are going to trade. If you are the high type, you are not going to trade. Arranging terms, we arrive at this term, at this expression. And you can easily show that this P is larger than Vs. So meaning that, the equivalent price is higher with pooling than with separating. And just intuitively, this is just because pooling means that, this asset is always being used to create the gains from trade. Separating means that only the low type asset is being used for production. So now, pooling creates more gains from trade, and this is going to translate into a higher asset price. Okay. Now, once we have this, the problem is that we get equilibrium multiplicity back. The reason is that pooling equilibrium exists if and only if this Vp is larger than this. Separating equilibrium exists if and only if Vs is less than the lower bar. And since Vp is larger than Vs, both inequalities can hold simultaneously. Okay, so this is why we actually get this equilibrium multiplicity. Oh, sorry. So again, like here, notice that we already applied the Wilson's equivalent selection to this, but we still have equilibrium multiplicity in this region. Okay, so this is what's happening with, without security design. With security design, so what you can do is the following. So effectively, the problem is the separate equilibrium, because pooling is a good one here. And the reason is that, again, this asset is being used, is traded, whether it's high quality or low quality, and that's good for production or to create gains from trade. Separating excludes the high type, so this is bad. So we want to do something about this separating equilibrium. Okay, so what can you do? Well, so in order to see, what we need to do, so we can just look at the incentive compatibility in the separating equilibrium. So I mean, we need to look at what's happening in separating equilibrium. So in separating equilibrium, so we have this inequality. The high type prefers not selling to selling. Okay, that's why the high type is not participating. And so now, what we want to do is, well, in some sense, this is how type thinks. Well, he's getting only SL plus fee, but he's paying way too much, SH plus fee. Okay, so now it's going to help if we reduce the price the high type is paying somehow. Okay, what can you do? Well, you can actually use the debt instead of the equity. Or if you let the high type not to give up the entire this payoff, then it's going to relax the high type's incentive compatibility, and it's going to help. So that's the basic idea. And so in particular, specifically, suppose that the face value is equal to SL plus fee. So meaning that if you have a high type, you effectively sell the asset, or later at the end of the period, you don't have to just give up this SH plus fee. You just need to pay SL plus fee. Meaning that you can retain this SH minus SL, the difference between this, the dividends from these two different qualities. Where what it does is that it increases the high type seller's payoff when he sells. Because in some sense, now you have lower risk, right? So now you sell the asset or you trade, but you know that you are not giving up the whole payoff from the asset. You are only giving up SL plus fee. You are retaining this SH minus SL. And you can actually show very easily that in this case, the high type always wants to participate. The high type always wants to trade. Okay. You just from this, you can just look at this inequality and can see that this holds. Okay, and what this means is that separating equilibrium cannot survive security design. If you apply security design, you can kill separating equilibrium. Okay, but this one is not the optimal one. We can actually do better. Okay, so how? Well, we can actually increase the face value. So instead of just asking S to be equal to SL, so consider any S between SL and SH. Well, now what's the expected value of the contract or the asset? Well, now the difference is that this is what the investor thinks. Well, I'm trading this, I'm getting this, I'm making this trade. If the owner is the low type, I'm getting SL plus fee, because that's how much he can pay to me. If the owner is the high type, well, he can pay me this face value, S plus fee, okay, because this S is less than SH. Okay, now, well, the expected value of this debt is equal to this expression, and this expression is increasing in S. So meaning that if you increase the face value, then it's going to actually increase the expected value of the contract, which is in some sense obvious, but this is going to be good because this means that you can create more gains from trade. So there's going to be more borrowing from investors to owners, and owners are the ones who make production, and now they can produce more. Okay, so you want to increase S as much as you can. But the problem is that you also need to satisfy the high type seller's incentive compatibility. So if you have the high type, if you don't trade, you get SH plus V. If you trade, then you get this price and apply the linear production technology, and then you also retain this SH minus S. And you can show that where if S is equal to SL, as we saw on the previous slide, where we have this incentive compatibility. If S is equal to SH, if it's very high, and if this this condition holds, then it's going to be reversed. So this means that where there's this S star that actually makes this high type incentive compatibility inequality hold with equality. Okay, and this is the maximum you can. So this is the highest S you can choose, because again, you always want to make sure that the high type is willing to trade. And of course, there's this dynamic element that so phi needs to be indigenized. Okay, and then but you can from this you can actually pin down this the optimal S star. But here the main point is that this S star is so you want to increase S as much as you can, but you also need to satisfy this incentive compatibility, and this incentive compatibility is what limits this S. Okay. Well, so I think that this is what's going on in this paper, and so I think. Oh, I guess I'm.
Yeah, you're a bit out of time, but
yes,
thank you very much
maybe
for
too much.
the nice discussion.
Just let me make let me spend just 1 minute. Okay, so again, I don't have any like expertise again in security design, so but I'm a theorist, so there are things you can actually consider theoretically, and those are the following two. I think one is, as we actually have this, I think we have this discussion with Victoria, but here, so again, what about if there are more than two types? And I think that here there is actually a chance that the optimal, the structure of the optimal solution is going to be actually the same, in the sense that you actually don't have to increase the number of securities. The difference is that Victoria was looking at this equilibrium environment where, like, whenever there's something left, there are some investors who want to create additional securities. Okay, here you are looking at this, like seller's problem, the owner's problem, and you are looking at this, like you are solving this owner's optimality condition. And I think that there's a good chance that typically in this kind of adverse selection problem, this is what you get. Even though you have a continuum of types, very often you just divide this the whole types into two. Okay, so that's the typical result. I don't know whether it's going to apply here, but I think that there's a chance. Okay, just one. Another one is that where adverse selection is assumed to be short, meaning that the type is revealed in each period. I understand why the authors made this assumption. It's just for simplicity, but this also means that there are other like dynamic aspects you can incorporate into this framework. Okay, so I don't know what they are, but there might be something interesting. So, well, let me stop here.
Oh, thank you, Teddy. Yeah, let me just probably conclude, and also just to answer very briefly. I think you are spot on in terms of the main mechanism. I think here the reason why Wilson kind of refinement doesn't remove multiple equilibrium is that, so if I think Wilson's refinements sort of help coordinate agents, say offers, so that we end up in a better equilibrium, eliminate the Pareto dominating equilibrium. The reason why that refinement doesn't work in a dynamic environment is that Wilson refinement allows people who kind of live in a particular period to coordinate. But the multiple equilibrium in a dynamic environment is about the miscoordination between, say, agents over time. So like the reason why there's a world bad equilibrium today is because I believe someone in the future is going to do something suboptimal or something crazy or something. And then it's a bit, so the question is how we coordinate people dynamically. That's why I was surprised when we started this project that when we allow security design, somehow this dynamic mixed coordination, the multiple equilibrium induced by dynamic mixed coordination disappeared. Exposed, it may not be, yeah, but so anyway, so that's the only thing I want to say. About your suggestions at the end, maybe we can talk more privately. I have to think more about this. Yeah. Thank you. If there are no, sorry, we went over time a little bit. If there are no other questions, comments, so that concludes our workshop. If you want to stick along a bit longer, I'll be still online.
Thanks so much to the organizers.
Thank you everyone for coming and for contributing to the workshop.
Thank you.
Thank you very much.
Thanks.
Thank you.
Xing Xing.